The Bears are unhappy. The Bulls are unhappy. Everybody's sort of universally unhappy.
Right now, folks are pricing that this is going to be a very tumultuous debt ceiling.
It feels like there needs to be another round of drama before they come to resolution.
We still look for the market to panic a bit more.
I would still put a hike in June or July at kind of the 30 to 40% range.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Do you remember trade war optimism? Remember that game?
Yeah.
Wasn't that fun?
No.
Debt ceiling optimism. Welcome. From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive 0.2% on the S&P. We have some debt ceiling optimism, TK.
Yeah, that's a lead story, but I think it's more than that. I think it's more than just a debt ceiling. I'll go with you. You know, the president canceled the trip. He is in Japan. Amory Horton will be there. An important interview coming up in 15 minutes, John. But yeah, it's the debt ceiling optimism, but what else is going on? This is important. Our first guest this morning, folks, is an unconfirmed bull. I mean, it's percolating, John. There's people, Stevie Cohen, New York Mets. Mets are not optimistic, but there's.
I'm with you.
And Alicia Levine, I mean, there was we opened the show. Everyone in Bramo is unhappy. That's the truth.
Data doesn't back that up right now.
No.
Data's pretty resilient.
Yeah.
Soc Gen's Kit Jukes, his words, nibbling away at those rate cuts that are being priced for the second half.
Yeah.
I'm calling this the bumpy road to absolutely nowhere. Tuesday, biggest one-day loss since May 4th. Wednesday, biggest one-day gain since May 5th. What does that tell you, Bramo?
Basically, bumpy road to nowhere. I'll just repeat what you just said. Basically, we've been range bound, and there's a little bump in perhaps for the direction, and people are calling this a risk rally. Here's the issue, that tail risks are basically being taken off the table, potentially, maybe. And that, I think, is what people are looking for, a sense that the catastrophic possibilities aren't necessarily as present as they were perhaps a week ago.
Are rate cuts being taken off the table?
Slowly, not all at once.
Yeah.
Slowly, but not all at once.
It's interesting. You know, I really did a lot of fancy Bloomberg analysis today, John, and we have not broken out. It's, you know, is it going to be breakout Thursday? It was not breakout Wednesday. But it's just interesting to see. We're buttressed up against resistance and support, and it's like we're not there. SPX 4180. Excuse me, on Standard & Poor's 500.
On the economy, I think Enda Karen Reed Pickett did a great story yesterday on the Bloomberg Tom. We'll cover that a little bit later this morning. Just pushing out the recession calls. Just pushing them out. Consumer still robust. Looking at housing data, activity still signs of life. Look at the rents in New York City. We'll talk about those numbers later too. They are awful. They're so punchy at the
punchy.
They're ridiculous.
Awful.
Translate
Which side
punchy.
is he on?
Just not good. What do you think?
Ridiculous.
What do you think? You on the other side of this trade?
Yeah, obviously, I own all the commercial real estate. No, I'm kidding. Yes, that's ridiculous. To pay a median of $4,000 in New York City. That's where we're at.
And what you do, folks, to do this correctly, we got to move the show forward. But 4,000 times 12 is 48,000, and there's your income you need to rent the unit.
Well, that's
and it's
post-tax.
like, are you kidding?
That's
post-tax. Thank you.
Yeah.
And if you're single, particularly, and you add those four taxes together, it's like, okay,
Real money.
Real money.
You wonder why they're going to Florida.
Yeah.
Wonder no more. From New York City, let's get to your price action. An expensive New York. Positive 0.2% on the S&P 500. Yields higher by a couple of basis points. On a 10-year, Lisa, 358. Just a lift over the last week. Monday, Tuesday, Wednesday, Thursday. Yields up every single day at the front end of this curve.
Honestly, to me, this is the question. How long can we continue with the sense that perhaps rate cuts being taken off the table and the optimism that we've been gleaning, I guess, from retail sales? I mean, the headline numbers haven't been that great. We get some further ones, but the gains in the stocks have been pretty resilient. Walmart is reporting earnings around 7 a.m. Ross soars after the bell. Alibaba also before the open. Do they confirm the sense that consumers are still spending, perhaps not in home goods in particular, but in other areas not supporting earnings? Today, we've got a slew of data, including 8:30 a.m. U.S. jobless claims, 10 a.m. April existing home sales, and the Conference Board's leading index. Really curious to see if the initial jobless claims continue on that upward trend. And today, a host of FedSpeak. You get to do this all week. It includes Governor Philip Jefferson.
We're still speaking.
Fed Vice Chair for Supervision Mike Barr. That's going to be alongside FDIC Chair Martin Grunberg in front of Congress. And Dallas Fed President Lori Logan. Also, Janet Yellen is going to be speaking later as well as she talks with some of the bank executives to get a sense of the debt ceiling.
Chairman Powell tomorrow as well. The FedSpeak continues. The marathon of FedSpeak so far. We're so excited. Max Kettner, Chief Multi-Asset Strategist at HSBC, has been bullish this year. Max joins us now. Max, great to catch up with you, sir, as always. Max, you talked about that sweet spot that we're in, which keeps you bullish. Are we still in that sweet spot?
Yeah, good morning. I think we are. I think we're right in the middle of that sweet spot, actually. When we look at some of the data, right, you guys were just talking about the initial jobless claims, right? They've been on an upward trend. To be fair, it turns out that probably some of that data is probably wrong because of that, that data glitch we had in Massachusetts. But on the other hand, even if you believe that data, you could say, well, the non-farm payrolls are better than expected. The jobless claims are worse than expected. So you are in this sort of limbo where the data is not clear cut. For us, that is perfect. It's the perfect Goldilocks backdrop where it's a bit of food for thought for the bulls, a bit of food for thought for the bears. The rate cuts are not being priced out yet because we particularly see U.S. headline inflation go towards 3% in the next couple of months. So, you've got mixed data, but data on aggregate beating expectations, but not too much. Inflation heading lower. What more do I want?
Max, a lad like you may not know the New York Metropolitans, but Steve Cohen is the owner of the Mets. He runs a small hedge fund shop in New York. He shares your optimism. He made that very clear yesterday. I think of the Cohen-Kettner nexus, and for you, it's based around how corporations adapt. How are corporations adapting right now that leads to your optimism?
Yeah, I think the AI theme in particular, right? If you look at Asia, for example, it's a pretty big theme, and it probably will continue. Perhaps it may be a bit overbought and a bit extended in the short term, fine. But I think what we are seeing is, even aside from the AI and the whole structural transformation theme, in fact, when we look at the corporates, things are looking much, much better. The only thing where companies are actually responding less positively on is if they are asked about, during, for example, earnings calls, about the stuff they are not in touch directly. If they are asked, for example, about the general sort of top-down macro backdrop, then that sentiment towards that general macro backdrop, that's been deteriorating. We have seen that for quite a while already. However, when they're talking about their own earnings, their own sentiment, their own margins, right? The sentiment on the stuff that they are producing, the stuff they're doing on their own, that sentiment has actually been brightening up throughout the entire year already. It's been brightening up in the Q4 reporting season, and it's just continued now in the Q1 reporting season as well, that the sentiment on the stuff that they've got a handle on themselves, on their own stuff that they're producing, they actually feel quite positively about that.
People are throwing around this word risk on, risk off. Are big tech stocks risky assets, or are they defensives at this point?
Oh, that is a very good question. I think actually from a multi-asset perspective, from an asset allocation perspective, it is still a heavily frustrating environment actually, because I don't think it is a risk on or a risk off environment. We're still in an environment where it's everything on or everything off, right? At the end of the day, we've seen treasuries post gains, the duration post gains since the start of the year, equities post gain, credit, EM, right? So we've seen pretty broad-based gains, and in that regard, then I wouldn't call tech either defensive play or a risk-on game. I would call it the play that is really the geared game on everything on, right? Because. And why is it everything on? It's pretty simple, because essentially we have priced these rate cuts in, right? Front-loaded these rate cuts. We've got data that is not falling off the cliff. We've got inflation heading lower. So it's all sort of everything is working. The big danger, I think, will come towards the second half of the year, where then perhaps inflation will re-accelerate. We see it re-accelerating above 4% by the end of the year. And then perhaps some of those rate cuts have to be pushed back again. And then the geared play of tech will work exactly the other way around, that it actually will be a geared play on the way down as well.
At that point, it could be an everything off kind of moment once again. Is this the new normal in terms of everything on, everything off, 60-40 not working, or is this just a temporary adjustment on the way to something more normalized?
I think if we're talking about the next couple of months until, let's say, the end of the year, I think that is the new normal. I don't see that change in the next sort of 2-3 months. In fact, I would actually genuinely hope, I would really, really wish I had that really bearish view that so many people are sharing right now, because then you could have the classic sort of recession playbook. You could say, I want to have bull steepeners, the defensives, right? Telcos, utilities, the defensives, the bond proxies. Then the cycle ends, inflation is killed. We're going to start from scratch. Happy days, right? That is the much easier scenario. The scenario that we've got, particularly from a macro perspective, from a growth, from an inflation perspective, is that it's going to be a much more painfully slow process the next year, year and a half. And that, from an asset allocation perspective as well, speaks for that sort of everything on and everything off, those locksteps being much more the new normal, at least in the next couple of months.
It's certainly a muddle through, that's for sure. Hey, Max, wonderful to get up to speed with you. Max Kettner there of HSBC. Stand bullish. The muddle through, the sweet spot for him to be constructive on this market. Your 2 years repriced over the last few days, back through 4% and now 4.16. Lisa thinking about 4.20 on a 2 year all over again going into Chairman Powell tomorrow.
But it isn't trading like a penny stock. So I guess that you can get that kind of sense that perhaps people are slowly adjusting to no rate cuts, but not necessarily this year at least. But it isn't necessarily a wholesale sudden move, which is the reason why people can kind of absorb it without some massive sell-off in some of the duration-heavy assets.
I'm trying to triangulate over to some of the data on the Bloomberg that's less the obvious, like the 2-year yield, I think is the important benchmark. And one is the euro-yen, John, weak yen, strong euro, and the euro's been weak, as you know, 110 down to almost a 107 print earlier this morning. And the answer is euro-yen is not broken out weak yen. It is not broken out. And the other is a 3-month, 10-year spread, which is maybe more of a pro spread, and it's bigger inversion, but again, it hasn't broken out. We're not there to the there of a breakout on this Thursday.
No, these are really subtle moves, but I'd pick up on a couple of things if you want to go multi-asset, cross-asset right now, Tom. Copper new lows for the year. That's something to look at in the commodity market. Disappointing data out of China, Europe, euro very close to a 107 handle right now on euro dollar.
108 something, right down there. And yen, as I look for renminbi, rather, as I look for John for this morning for the first time, 7.03, and that's with convexity. That's moving. That's accelerating. Weaker renminbi, a la the copper trade.
You've got all these rate cuts priced for the second half. Got a lot of people short the US dollar. This is what Kit Dukes of SocGen is talking about this morning. And the data kind of shifting the other way, Tom. And just slowly taking a bite out of those positions. Just slowly, not all at once.
I mean, folks, it's really deceptive now. It's boring. It's a snooze fest. It's not surveillance snooze fest right now. There's a lot
Not
going
at all.
on.
Do you want another number that starts with a 4? We talked about it briefly. This from appraiser Miller Samuel. New York City apartment rents, the median rent in Manhattan, $4,241. 8.1% higher than a year ago. Still climbing.
4241?
Yeah, still climbing. From New York City, equity futures on the S&P 500, just about positive.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and other group of 7 leaders have begun arriving in Japan for their summit. China and Russia will be the problem at the top of their agenda starting Friday. Russian President Vladimir Putin continues his war in Ukraine, and a post-pandemic China is busily expanding its economic and strategic clout. Meanwhile, China's President Xi Jinping is holding his own summit. The 2-day China Central Asia Summit will assemble the leaders of Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, and Uzbekistan. It's Xi's way of reminding the G7 of China's influence outside the U.S.-led world order. Hungary will block further European Union aid to Ukraine. That's because of what the Hungarian foreign minister calls an increasingly belligerent attitude on the part of the Ukraine toward Hungary. One of the complaints is that Ukraine singled out Hungary's largest bank for doing business in Russia. There's growing speculation that Ron DeSantis is about to announce that he's challenging Donald Trump for the Republican presidential nomination. The Florida governor is summoning financial backers for a meeting in Miami next week. While they're there, the donors expect to make fundraising calls on behalf of DeSantis. And Deutsche Bank will pay $75 million to settle a lawsuit in the U.S. involving the late disgraced financier Jeffrey Epstein. Victims of Epstein's sexual abuse accuse the German bank of facilitating his sex trafficking operation. J.P. Morgan faces a similar suit. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Confident that we'll get the agreement on the budget, that America will not default. And every leader in the room understands the consequences if we fail to pay our bills. And it would be catastrophic for the American economy.
I'm optimistic of our ability to work together Do we have obstacles? Yes, we have a big obstacle in the White House. If there's one thing you know from me, I never give up. I have the grit, the perseverance, and we're going to get it done.
President Biden, Speaker McCarthy, all on the same script yesterday, Tom.
Oh, they were. They were
you know, constructive. We're not going to default. We'll get it done. The problem's in the White House, just so everybody knows, according to Kevin McCarthy, House Speaker TK. You clear on that?
Yeah. Can I just have a moment of silence for our Capitol Hill team? You know, they've got to deal with this seriously day after day after day. And God love them. They got the patience to do this. You know, I don't know what happened. What happens today? Nothing, because the president's in Japan, right?
Mood music plays well in the media.
Yeah.
We like playing little snippets like that. But ultimately, have we moved on substance? No indication of that just yet. It's nice they're playing nice. I think that's good. That's good.
Right.
But ultimately, no indication there's going to be a deal anytime soon, apart from them saying there might be.
There will be symbolism on Friday. The last of our World War II presidents will visit an emotional point for Americans and for all of us in Hiroshima, Japan. Anne-Marie Horton, our Bloomberg Washington correspondent, joins us now at the beginning of this trip. She is at Hiroshima. Anne-Marie, good morning to you in the 6 o'clock evening of Japan. What is the president's schedule as he rests for a busy Friday morning?
Well, the president landed and immediately got to work. He had a bilateral meeting with the Prime Minister of Japan, Fumio Kishida, who, of course, this is his hometown. And when you talk about this historical significance, it is the Japanese that really want to make sure that nuclear nonproliferation is also on top of the agenda, because looming large over this meeting, of course, for the president personally, is going to have one foot here in Japan, but really another foot in Washington, D.C., cutting his trip short to make sure he can get back for the debt ceiling negotiations. But also, of course, it's going to be heavily focused on China, as well as, of course, on Russia's invasion of Ukraine.
Is this a new leader for Japan that is a continuation of the LDP leaders we've seen for so many years? Or does he meet a new politically vigorous Japan?
Well, this is a leader that has, I believe, out of all of these leaders meeting at the G7, the highest when it comes to polling numbers, something that I think President Biden would be very envious of as he's sitting down with him. This is someone who also you've seen recently good growth numbers out of Japan, numbers in terms of their stock market is doing well, the best since the 1990s. And on top of that, this morning, what we've learned from the Prime Minister when he was sitting down with chip CEOs, and one of them, of course, being Micron, a huge U.S. company, and they're now doing a deal to have a factory right here in Hiroshima, and there's going to be some incentives for them to come here to Japan, but this is all part of what the United States is trying to do to make sure they could shore up supply chains outside of China.
It's pretty interesting to think about the split screen right now with G7 leaders meeting, and then the China Central Asia Summit taking place at the same time, with China meeting with Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, Uzbekistan at the very same time. Is this precedented? Do we have a sense of some sort of gathering where China tries to basically show its sway with the world at the same time that G7 talks about how to deal with the threats that have emerged from that nation?
Well, I think what you see is Xi Jinping trying to shore up other countries while Biden and other world leaders are looking to really the global south to make sure they can keep them on board, not just because of the struggles they have in terms of what is going on with higher inflation, energy costs, when it comes to agricultural costs because of Russia's invasion of Ukraine, but also wanting to make sure they're looking to democracies, not autocracies, when they need help. What you see here also, I think, interesting is not just this split screen that probably matters to the White House, but also matters to Moscow. These are former ex-Soviet states, and Vladimir Putin is not there, but they're meeting with these Central Asian countries. That is critically important for Xi Jinping to want to make sure he has good trade ties and also influence in these capitals.
Anne-Marie, there's also an issue right now of what happens when President Biden goes back to the U.S. and skips a number of steps in his trip. Does this change the U.S.'s presence there, that the focus is squarely on domestic issues and not so much on some of the international concerns that all of the members share?
Well, there's a tremendous amount of angst at the G7 finance ministers meeting in Niigata, where I sat down with Treasury Secretary Yellen. This is what she was focused on, because this was looming large over her and Fed Chair Jay Powell, who was there, because when you talk to other finance ministers on the sidelines, they were concerned about the economic risks emanating from Washington, D.C., even though they were there to talk about other matters, most notably China. So this is certainly something that is going to weigh on the president. He doesn't expect a deal by the time he gets home. But, of course, he had to cut his trip short. He was making this huge trip as well to Papua New Guinea. The White House was touting this as the first U.S. president to set foot in Papua New Guinea. We do know that Xi Jinping met the prime minister of Papua New Guinea in November. Earlier that year, he sent his top diplomat to Papua New Guinea. Potentially, people were talking about maybe Beijing was going to try to go for security alliance, the way you saw China do with the Solomon Islands. And then he was going to meet the Quad in Australia. And all of that has been has been scrapped. So the criticism will be that domestic policy potentially, at least this the critics will say, is undermining foreign policy as the U.S., especially now, is trying to shore up alliances as they look to counter Beijing.
You know what this G7 needs, Tom? Analysis of Real Madrid and Manchester City. That's what this G7 needs.
They do.
A little bit later.
Yeah,
AMH, thank you.
Prime
Anne-Marie,
Minister
over in Japan at the G7.
Provide a brief on
Prime
that.
Minister's probably got things to say. You just tweeted an amazing stat from Opta. It took until the 25th minute for Real Madrid to complete a pass in Manchester City's half last night after getting absolutely crushed 4-0.
For Americans not up to speed on the wisdom of John Ferro, this was the most extraordinary match I've ever seen. We've seen this in college where one team dominates, but I've never seen a professional game where one team was almost exhausted by dominating for minute after minute after minute after minute.
Not at that level. Not at a team, not by a team, I think, as elite as Real Madrid. I haven't seen a 25 minutes like that. I just sat there almost in awe of it.
Yeah.
Man City were just there, just full press.
Inform
Real
us
Madrid
about
sitting
this
so
coach.
deep and couldn't get out of their own half.
The coach put this together, right?
Pep Guardiola's got a big role to play. They've assembled a fantastic team, but money only gets you so far.
Exactly.
You've got to get them to play with each other. And he seems to have done that in a beautiful way. The other thing I would say as well is that team seems to be peaking at just the right time.
Yeah.
To get your team, your side to peak going into towards the end of the season is pretty special. He seems to have achieved that.
Asking for a friend, is he available for the tots? They seem to have an
no,
open.
I don't think you have the budget for that kind of coach, because he's going to want to spend a lot of money to sort out that team.
It's amazing, and what's so cool about it is they've got the superstar guy, the guy's 6'7", the blonde. Haaland. And he's like, his strength is he's not consequential because the others are so good. And then all of a sudden, boom, he's
You've got all these kind of match-offs, Tom, all around the pitch. So let's pick out one. Kyle Walker, Vinny Jr. Walker wins that easy. Grealish down the left side. Grealish won that easy yesterday.
Yeah, I'm a big fan of him.
It's super, super impressive what they achieved.
So what do they do next?
Good luck to them in the final. They'll be the overwhelming favourites against Inter in Istanbul.
Oh, I thought it was AC Milan.
No, it's not.
Milan.
You just taking
Inter
digs
in
at
Istanbul.
my beloved
Really?
AC Milan.
Seriously?
I wouldn't like to see my AC Milan go against that Man City side at the moment. That's for sure. That could be
or
ugly.
the tots for that matter.
Yeah, I agree with you. I agree.
It was just great. I enjoyed it immensely, and thank you to CBS for covering it.
They've done a great job, you know. They've done a really, really, really good job.
It's better than some of the other stuff that we have to see.
We won't talk about that. Okay. We will talk about this a little bit later this morning. We'll get earnings from Walmart. Look out for that. Should drop in about 35 minutes' time. Bramo's still with us.
Yeah.
She wants to talk about the Fed speak, TK. She's excited for that. Chairman Powell tomorrow. Tons of Fed speak through this morning. With the bond market that's repricing off the back of pretty decent data. So the next stop for the data story is going to be jobless claims in about 2 hours from now. And Lisa, claims over the last few weeks kind of climbing higher, breaking out. Still low historically, but breaking out.
Giving a sense that perhaps they are going in the right direction, but not as quickly as people thought. The issue that people are struggling with is no one data point is screaming conviction on either side. So you continue with this sort of range of potential both sides risks that we just keep seeing.
4-week moving average claims, 2 standard deviations, 254,000. That's my statistic.
Just slowly it's happening. You can see it.
It's slowly happening. We're not there yet.
I agree. Equity markets right now positive by 0.2% on the S&P 500, a lift in the equity market. The data so far this week pushing back just a little bit against some of the gloom. We get more data a little bit later this morning. Jobless claims coming up shortly. Live from New York City, welcome to the program on TV and radio. This is Bloomberg Surveillance, and here's some of the price action for you. Equity markets on the S&P 500 positive by close to 0.2% on the S&P. On the Nasdaq up by 0.2% as well. Yesterday, the biggest one-day gain on the S&P since May 5th, which followed the biggest one-day loss since May 4th. We're calling this the bumpy road to absolutely nowhere, and that bumpy road to nowhere continues. Let's see if we can break out of this range on the S&P 500. In the bond market, repricing yields higher Monday, Tuesday, Wednesday, doing it again Thursday morning on a 2-year, 416.28, just getting closer to 420. The data coming in the US's favour, pushing out the recession calls, taking a nibble, to borrow the phrase from Kit Dukes of SocGen, out of the rate cuts price for the second half, supported by a lineup of Federal Reserve speakers this week who are determined to stay the course, Tom.
Stay the course and drift away from the rate cut discussion as well. It's very flexible right now, as we heard from Max Kettner of HSBC here earlier in his optimism. Right now on American Economics at Barclays, Pooja Sriram joins us for a brief. What has changed, Pooja? I'm fascinated, not about a look back to Q1, but like where we are right now. Are we above a 2% real GDP guess for the second quarter?
Well, thanks for having me on the show, Tom. Not about 2% GDP. Our base case is, we're still likely to slow from Q1. We do track GDP on a data-to-data basis. But to your point, we are starting to see some upside. Of course, we're very early on in the quarter. In terms of the data that we have. But, we got retail sales this week. We got industrial production, all pretty sprightly prints considering, where we thought we would be. So definitely more momentum in the U.S. economy than we had expected going into the second quarter.
And then overlay inflation on that. Let's call it a stubborn inflation. Was that the word, John, for the Fed speak? Like, was it 2 days ago? Stubborn was mentioned 14 times.
I think someone might have used that word, yeah.
14 times, I believe. They said stubborn. When you have a stubborn inflation and your optimism on GDP, do you get a nominal GDP that's still sprightly? Like, to me, the lead here is nominal GDP hasn't come in, has it?
No, not yet. But to your point, I think we are expecting that we should see some progress on inflation in the coming months. The bump that we had in March and April from goods prices, we don't expect that to sustain. We are seeing some pretty good news in the housing sector already. It's, of course, we need to wait and see if that continues. And then, of course, we've had, a little bit of good news in terms of rent or rent inflation. That seems to have stepped down from where it was. So, although activity has been holding strong, I think we are getting some pockets of good news as far as inflation data is concerned. And I think that's something that we would be watching quite closely going forward.
Pooja, if we take all the tail risks off the table, let's say we don't get some sort of banking crisis and the worst of it's behind us, and that, yes, there's a slow grind, but nothing catastrophic. We don't get a debt ceiling default or debacle or whatever you want to call it, and then all of a sudden, are we looking at a soft landing?
Well, that's I think, a plausible path to get there. There are risks. And I think one of the risks is, activity continues at this pace that is, not enough progress for the Fed. And if activity is continuing at this pace, let's say inflation also doesn't come down as much as, they expected it to, that's the tricky situation. But, as you said, if everything pans out, where, it's what we call a slow grind lower in terms of inflation, there's a little bit of labor market softening, then it's quite possible that we do get that soft landing that the FOMC is aiming for. But, risks on either sides for sure.
Does a soft landing like that necessitate inflation to remain higher for longer, or does it just mean it's going to take a little bit longer for inflation to come down, and then everything will go back and be fine, just without sort of the massive swings in the economic condition that a lot of people are prepared for?
I think in terms of how that soft landing would look, you would definitely need a lot of softening in the labor market conditions. So you will need to see labor demand come off. You will need to see wages starting to decelerate. And in that world, one could think of a situation where, inflation is around the 3% handle. Let's say core CPI is around the 3% handle, and then they wait and watch to see how that sort of works its way lower.
Let's go through the Fed speak for the day ahead. If you're just tuning in, welcome to the programme. This is Bloomberg Surveillance. A little bit later on today, we're going to hear from the Fed Governor, Jefferson. You're going to hear from Barr, Vice Chair for Supervision at the Federal Reserve. You'll hear from Logan too. Tomorrow, a big day. You'll hear from Bowman. You'll also hear from Williams. You'll hear from Chairman Powell as well. There's this big conversation about jobless claims in the mix at the moment, breaking out recently. Claims at the moment sitting at 250, 264. The survey today is 252. This is what Mike Gapin of Bank of America said recently on this, Tom. The recent rise in initial jobless claims was likely due to a spike in claims in Massachusetts that was not reflective of individuals. Now, these guys are really digging into the data here.
They're digging into it, yeah,
so
weekly data.
Mike and the team are basically saying, excluding Massachusetts, initial claims have moved sideways and continue to point to limited layoffs. So how much signal is in claims right now?
The answer is we don't know, but in their defense, every week it's either California or it's North Dakota, or in this case it's Massachusetts. It's always lumpy. I've always gone to the 4-week moving average, and John, that moving average, it was, as early as February of this year, it was under 200,000, and it's come up sprightly, and my tension point, as I mentioned earlier, is a 254,000 4-week moving average, somewhat of a pseudo-monthly statistic.
Pooja, I just wanted to bring you into the conversation for a final word on that. What is your read on what's happening with jobless claims at the moment? Is there some signal there or not?
There is some signal from that, but to your point, we found something similar when we looked at last week's claims, and a lot of that did come from 2 states, California and Massachusetts, and the read on Massachusetts wasn't entirely clear. So we weren't ready to take too much signal from that. But to your point, claims have been crawling higher, perhaps, not at a pace that one would have expected it to. And today's data would be interesting to watch. In fact, the data that we get today would be for the payroll survey week, so it includes the 12th of the month. So it would carry a fair bit of signal as to what's happening on the labor market. Our expectation is for a print of 250,000. So not very high compared to, say, where we were a month ago, but definitely moving in the right direction.
Pooja, great to catch up. Pooja Sriram of Barclays on the latest data in America a little bit later this morning. 8:30 Eastern Time, TK. Jobless claims coming out a little bit later this morning.
Massachusetts has been cleared out. I don't think you're going to hear much from Massachusetts in this claims. Last week, I'm told from a good source, it was a middle relief clear out of the Boston Red Sox.
Right.
They were all down getting the claims in. It was like, last place, let's go. Let's move 5
it's
guys
only May.
out.
It's that bad already?
May is deep into the season for a Red Sox fan.
Okay.
Usually the season's over about April 28th.
It's over now?
No, it's a very strong division. You know how there's different divisions? The division there in the East with Tampa Bay and the dreaded New York Yankees is actually very strong. So I'll give an asterisk.
I saw the controversy with Aaron Judge. Do you see that?
Yeah. A
bit of side eye, and they suggested maybe he was cheating, which he's pushed back aggressively against.
Yeah, well, there's a little controversy there. I'm going to cut him some slack.
Just a touch.
Yeah, cut him some slack as well.
Got a great guest now, TK.
We are. Right now, I think we're going to go to Anne-Marie Horton in Japan, and with her is Admiral John Kirby. He's National Security Council Coordinator for Strategic Communications, this for America at the G7 meetings.
Thanks, Tom. And that's right. He's on the ground less than 4 hours, and Admiral Kirby is joining Bloomberg First here as he lands with the president for this really important G7 summit. But of course, the president is scrapping the remainder of this foreign trip he was supposed to have, Papua New Guinea and Australia. How much do you think that domestic policy concerns are undermining the foreign policy goals of this administration?
It's not about undermining our foreign policy goals. I mean, the president has really revitalized. He's really put a lot of energy, particularly into this part of the world. I mean, here we are in Japan for the G7. Just a few weeks ago in San Diego, we were standing next to Prime Minister Albanese and Prime Minister Sunak to unveil the next phase of the AUKUS agreement. And of course, he's already had a chance to meet with all the Pacific Island leaders at the White House last year. We'll do another one here in the near future. So we have invested a lot of time and energy into this particular part of the world. And today's visit, this G7, I think, is just further proof of that.
But at the same time, the president loves to use these moments like a G7. He reminds the world America is back. He tries to draw parallels from democracy vis-a-vis autocracies, what's going on in terms of Beijing, what happens in Russia. How hard is it for him to deliver that message to other leaders when he was supposed to be the first U.S. president to go to Papua New Guinea? He was supposed to go meet the Quad in Australia. And this is where he wants to spend his time, like you said, in the Asia Pacific.
But the president knows, and so do these leaders of democratic nations, that if you don't take care of the nation's debt, if you allow the United States to default, virtually nothing else matters in terms of what you're trying to do around the world. I heard comments, by analysts that our credibility in the region is suffering because, we're not going on 2 other stops. But the credibility really suffers if we end up being a debtor nation, if we default.
That was the message I got in Nagata from the foreign ministers. Will the president be able to...
If we become a deadbeat nation, then our international credibility and standing suffers. So the president is doing the right thing here. Obviously, the G7 is important. A lot of things to discuss while we're here in Japan. We can reschedule a trip to Australia. We can reschedule a trip to Papua New Guinea. You know what you can't reschedule? You can't reschedule the looming debt ceiling deadline. That is a hard fixed thing, and we've got to make sure we get these negotiations through.
Critics will say then the president didn't manage this correctly. He should have been speaking to Speaker McCarthy earlier so he didn't have to cancel his foreign trip. But do you think the president here in the G7 will be able to say to leaders the U.S. will not default on its debt?
Well, the president's optimistic. He said that before we left. He said that he's optimistic that we'll get there. And so that's one of the reasons why we're going home a little bit early so that he can be there to make sure that Congress does its job. But let's go back a little second on the talking to Speaker McCarthy. Defaulting is a congressional duty. It's in the Constitution. There didn't need to be negotiations over the debt. Now, the president is willing to sit down and talk to Speaker McCarthy about the budget and appropriations, and we'll do that. But when it comes to raising the debt ceiling, that is something that has been done 78 times under Democratic and Republican administrations, without negotiations, without having to have an argument about it. So there's no reason for, the argument that we should have talked X number of days ago. This is a congressional duty. They should just simply do their job.
This is something we're going to be closely watching here from the sidelines of the G7. When it comes to, of course, one of the biggest elephants in the room is going to be China. We know the U.S. wants to go after economic coercion that's coming out of China. Also, the Papua New Guinea trip was about deterring Beijing. Is there a concern from the White House that potentially, when it comes to, say, Papua New Guinea, that Beijing is trying to do a security agreement like they did with the Solomon Islands? How concerned is it about making sure that countries like that are on board with what the U.S. is doing?
Well, the trip in Papua New Guinea was not about deterring China. It was about, again, reinvigorating our vast network of alliances and partnerships in this region. A network, by the way, that China can't even close to match. Just can't get there. 5 of our 7 treaty alliances are in this part of the world, and a lot of people don't realize that. So there's a lot of network of partnerships and alliances here that we're trying to try to bolster. What we will still have discussions and some deliverables with Papua New Guinea. You'll see that, even though we're not making that stop. We'll see those move forward. I can't speak for what China's doing with each individual Pacific island nation. They have used a mix of intimidation and coercion, economic and security-wise, to try to have their way in this part of the world. We are not asking countries to choose between the United States and China. They get to decide what their bilateral relationships look like and who they associate with and what that association looks like. What we are doing is trying to show in demonstrable in ways that the United States is a reliable, stable, credible partner in this part of the world and around the world, and to give people alternatives to the coercion and the intimidation that the Chinese tend to demonstrate.
How close are G7 leaders aligned on this point on making sure they are de-risking from China? Most notably, I'm thinking of Europe and Emmanuel Macron after his visit, where he said that Europe actually has strategic autonomy when it comes to China?
China's going to be key on the agenda here in Japan, and I think you're going to see the G7 leaders all speak with one voice about the challenges that China poses here in the Indo-Pacific and around the world, but also what some of the opportunities are as the G7 nations are to compete fairly, but to compete well with China.
Besides broad strokes of words, though, will there be any action vis-a-vis China and the G7?
Well, I'm not going to get ahead of the discussions. The G7 leaders will absolutely spend quite a bit of time here, as you would expect they would, certainly here in Japan, talking about the challenges that the PRC represents. They will, I'm convinced of it, that you'll see at the end of those discussions that they'll all speak with one voice about how we need to treat that particular competition, not just from a security perspective, from an economic perspective, from a diplomatic perspective.
Admiral John Kirby, thank you so much for joining Bloomberg TV.
Good to be with you.
That was, of course, the National Security Council Strategic Communications Director John Kirby. His first interview on the ground. He's been here for under 4 hours here in Hiroshima, Japan.
Spent most of that travelling from the airport, Tom, to an interview with Anne-Marie. MH, great work as always. Looking forward to your coverage through the G7.
This is accused, John. He wants to go to what the debate is within the administration, and particularly within the Pentagon, which is a reaffirmation of America in the Pacific Rim. This was blown up. We had a joint blow up by two presidential candidates at the same time, Mr. Trump and Mrs. Clinton, former Secretary of State, who decided we can't do trade with the Pacific Rim. That was sort of the politics 8 years ago. Now we've got the establishment of 4 military bases in the Philippines, around to the west, the South China Sea, Papua New Guinea. How many people watching today know where it is on the map? It's 138 miles from Australia on the South Shore and goes up again, buttressed up against China in the South China Sea. What the Admiral is talking about there is a reaffirmation of naval presence within the Western Pacific, and that's the churning here beneath the headlines on
These
China.
are very serious issues which, funnily enough, feel like a distraction right now, given what's happening in America at the moment and the fact the president is abroad, when at home there are these negotiations ongoing about the debt ceiling. What was the phrase that Kirby used then? We don't want to be a deadbeat nation.
Yeah,
and
well,
not meet our
that's
obligations.
percolating in the zeitgeist.
Pretty strong stuff, TK. Just to reset things for you, if you are just tuning in, your equity market slightly positive on the S&P 500, up by 0.26% on the S&P. Yields in the bond market shaping up as follows on a 10-year by 3 basis points higher. 360, let's call it, on a 10-year at the moment. I think we can just about call it that. 359 on a 2-year, Tom. 417, close to 4.17% on a 2-year this morning.
Killing me right now, folks. Bramo, it's killing me. Is well understood. I can never buy any financial securities. That's part of my agreement with Bloomberg. And it's killing me right now on the double we're seeing in some of these regional bank stocks. To provide medication, Gerard Cassidy joins us right now with RBC Capital Markets. Gerard, one of your colleagues in crime, Chris Marinac over at Janney Montgomery Scott, basically has a double price target on these banks. Is that too optimistic? Do you actually have a double price target on some of these selected regional banks?
Tom, we do, and I'm in your camp. I'm not permitted to buy any financial stocks either, and it kills you, especially with the preferreds, with the yields that they're offering. But the stocks came down to such low levels as a result of, as we know, the March Madness, the disruption in the market, the turmoil that was created by those 3 bank failures, and I think it was overdone. And you saw yesterday in particular, many of the stocks were up 5, 6, even 10%. I think you can see in some cases a double with selected names because it was way overdone to the downside in our view.
Is it all clear on this Thursday morning?
The short answer is yes. All clear. I would just refine that to say all clear on a deposit flight. For the problems we saw in March, it's an all clear. Now, the banks always have challenges like any industry. And so if we go into an economic recession in the next 3 to 6 months, even though yesterday's Atlanta advanced real GDP number came in at 2.9% for this quarter, which is a surprise to the upside. So if we have a slowdown or a recession, there will be challenges for the banks. But based on the problems we just came through, I would say it's an all clear.
What does all clear mean, Gerard? Does it basically mean we're not going to get a financial crisis akin to 2008, or does it mean something deeper in terms of not necessarily an acceleration in the number of insolvencies in this region?
Lisa, I would say it's the latter point, because when you think about what was going on during March and the deposit challenges during the week of March, what was it, 10th or 11th, it was quite frightening for a number of investors, and they sold their bank stocks because of that. We just don't see that happening because those three bank failures were idiosyncratic. They were very unusual, those business models versus regular banks, and we just don't see that type of failure or that type of problem going forward.
We're going to get a slew of Fed speak today where they're going to assess the economic scenario. And Steve Matthews at Bloomberg put out a story saying that next month's meeting, we are likely to get an upward revision to growth by these Federal Reserve officials. How much of that is fueled by this idea that these regional banks, once thought as cooperators in trying to bring down inflation and slow the credit impulse, maybe won't be such cooperators and will continue to expand loans and continue their function much more than people previously expected?
You said it well, to continue their function, because banks are in the business to lend. And if you're, they weight the risks of lending versus the quality of the applicant. And as you saw in the senior loan officer survey, which we chatted about a week ago or so, that the demand for commercial and commercial real estate loans is down quite a bit. So if this economy starts to show signs of maybe better strength and the demand starts to come back, the banks will definitely be lending. In fact, Lisa, the real risk, I think, to the banks is that they cannot get inflation under control. And we have a Fed funds rate a year from now that's close to 7%. That would be a problem for the banks.
What about the regulatory overhang? I mean, we're going to be hearing from Fed Vice Chair of Supervision today, Michael Barr. We're also going to be hearing from the FDIC chair. How much are you hearing this willingness to regulate further after perhaps this was, I don't want to say idiosyncratic, but maybe contained?
I think you will definitely see regulatory change as a result of what happened in March. We anticipate that there will be negotiations obviously going on with the large banks and the regulators to make sure that it's not a knee-jerk reaction to what happened. And I do expect it will take some time, as Vice Chair Barr has pointed out. We expect that they'll probably put a policy out there for debate by the end of the year, probably put it into implementation by the second half of next year, and it goes live probably in 2025. And I think it will be manageable. We just got to make sure it's not a knee-jerk reaction to what happened in March.
Not that I can take advantage, but Mr. Cassidy, your single best buy this morning to take advantage of this silliness?
I would say, Tom, that in the regional space, we would have to go with Fifth Third. As you know, they're based out of Cincinnati. And what's interesting about this story is that it's a very well-managed bank under the leadership of Tim Spence. But more importantly, longer term, you're all very familiar with onshoring and what's going on. And the state of Ohio is really at the center of that. So that's a long-term economic driver for Fifth Third, as well as KeyCorp and Huntington, which are all based in Ohio.
And what an interesting call to leave it on. Jared, thank you. Jared Cassidy of RBC Capital Markets. Connected to this conversation, is it the next shoe to drop? Commercial real estate. Prices falling in the first quarter for the first time in more than a decade. This data brought to you by Moody's Analytics. A less than 1% decline, but notable nevertheless, led by drops in multifamily residences and office buildings. The chief economist Mark Zandi over at Moody's Analytics saying this: lots more price declines are coming, TK. Now, this was a concern picked up by the Federal Reserve as well in their semi-annual financial stability report. Yep. The Vice Chair for Supervision at the Federal Reserve, Mr. Michael Barr, has talked about this as well. This is a major focus, TK, for you and for so many other people too.
Major focus, and John, I got a lot of humility here in that I'm really an amateur on it. My only solution is to read every single article I can, sometimes skimming them, of what was in 4 or 5 years ago and what the exit valuation is. And I think the operative number is more than a third haircut. Is what, if it's a bond, you're at 100 and you're moving out at 70 or 8 or 60 or 50. And it's property after property, even away from the ones we know are traumatized. That's what's important.
The size of the decline this morning, Lisa, that we're talking about is not notable. It's the decline itself. We just haven't had one for so long.
which is notable. Just basically, this is an area that hasn't been stress tested, right? And this is the concern. What else is under the hood? But I have to say, if you take a look at the valuations in the secondary market, it's been substantial, 15 to 20% types of declines in commercial real estate. So, how much is already priced in and anticipated by a lot of investors? This is really the issue with this market. It's not like these looming threats are unknown to people or unprepared for. And this is the reason why it's not going to necessarily be the boogeyman that people are expecting.
Well, they're certainly known. How well prepared for them we are might be a subtle difference there, Tom.
Yeah, again, my amateur take is to take SPG, Simon Property Group, which I'm told is like first class world, best in class, off a last decade high, down 52%. And that's, I'm told, the Bentley of it all. I read Cranes. Cranes is doing a great job. Bloomberg's real estate people are doing.
What's that like? What's Cranes like?
Property to property, I'd say, John, it's a really important question. They're doing a great job. Not every day. Every 3 days, there's a transaction, maybe a small building in Brooklyn. It may be something in Cincinnati we were just talking about with Gerard. And it just walks you through one given real estate transaction. And some are like, they were $100 million and they're selling them for $70 million, and some are a lot worse than that.
You want to talk about residential just quickly?
Yeah, this is not this is commercial.
You mentioned Brooklyn, residential. Rents in Brooklyn.
You're on a tear here.
Just going through these numbers this morning.
Are we?
No. A median 3,500 in Brooklyn now, up almost 15%. That's rent in Brooklyn. Median 3,500.
We did this on the break. It's take the rent, gross it up 1 year rent, and it's about a 30-year income is like rational. That's $154,000 a year you got to have in Manhattan.
How much is that you just can't buy? Right? I mean, how much is it basically people are priced out of buying, or they don't want to take out a mortgage at this kind of rate, so they are going into renting, and then that's pushing up the rents because you've got people who otherwise would be buying going into that market. And how much is this creating kind of a vicious circle right now?
This goes right back to the conversation we had through this week, work from home. Because if you've got to go into the office and live close to Manhattan, that's what you're paying.
How about work from South Dakota? I mean, you get to a point where everybody exits.
Totally. We'll continue this conversation. And some news on Deutsche Bank. They're not screaming, get back to the office. They're screaming, let's cut the office space. We'll come to that later. This is Bloomberg.
The Bears are unhappy. The Bulls are unhappy. Everybody's sort of universally unhappy.
Right now, folks are pricing that this is going to be a very tumultuous debt ceiling.
It feels like there needs to be another round of drama before they come to resolution.
We still look for the market to panic a bit more.
I would still put a hike in June or July at kind of the 30 to 40% range.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market not doing much this morning, waiting for numbers from Walmart. Those numbers will drop any moment from now, Tom, as we put together earnings for retail this week from Target, from Home Depot and Walmart any moment now.
In most optimistic Thursday you and I have had in ages. I mean, we've got Max Kettner on earlier from HSBC, and we're bouncing off what Stephen Cohen said, the owner of the Mets, and of course all his work at Point 72. We're going to advance that forward, John, and it's percolating here. What do you think? Debt ceiling? What do you think? Earnings was it Target?
Debt ceiling optimism, whatever that is. I mean, what is that?
I don't.
What's debt ceiling optimism?
I like what Admiral Kirby said, where he said we've done it 78 times or whatever, and it's just like, okay, raise the debt ceiling, let's move on. And we can't get there in this political moment.
Let's move on right now. We get some numbers from Walmart, including their full-year projections for EPS. So let's start there. For the full year, adjusted EPS, a range of $6.10 to $6.20. The previous range was $5.90 to $6.05. The estimate was $6.14. This stock is higher in the pre-market by 1.9%. Lisa, what else have you got?
Basically, total U.S. comp sales ex-gas up 7.3% versus an estimate of 5.8%. You could see across the board beating. And the fact that full-year adjusted EPS is coming in so far above expectations. Second quarter adjusted EPS, $1.63 to $1.68. They had seen $1.70, so that's slightly below, but they expect the rest of the year to pick up. Basically, this is confirming the view that perhaps there is more strength in the consumer. perhaps there is more strength in the economy. And it goes to this question of perhaps taking off the tail risks and having a soft landing be more of a base case for a growing number of people.
And I'm going to go, Lisa, to where you were on a 6.7 same-store sales, which is a nominal GDP equivalent. And we heard from Barclays earlier in the hour that nominal GDP may stay elevated. And whether you believe in nominal or real, whatever that analysis is, it's the wind behind you. I'm doing a sailboat. Can you see me in a sailboat?
Nice, that works. Can't see you on a sailboat.
The wind,
can see you as a passenger on a sailboat. Can't see you working on a sailboat.
I get so seasick. I get on and I lay down. Okay, wherever point A to point B, I'm laying down on a 3-island tour.
I can see that working.
Yeah.
Certainly not
USS Dramamine.
The rest of it. I don't see you jumping from side to side doing things with the sails. I wouldn't know what to do with the sails either, but I just don't.
Come about hardly.
Whatever that is.
Tom, go downstairs, sleep.
I'd do the same.
Have a Narragansett.
Walmart in the pre-market higher by a little more than 2%, raising the outlook. Let's whip through the price section for you. Elsewhere in the equity market on the S&P 500, equity's a bit firmer by, let's call it, 0.25% on the S&P. Yields a bit higher by 3 basis points on a 10-year, 359.44, and just to round things out at the front end, higher every single day this week. Monday, Tuesday, Wednesday, Thursday. Yields approaching 420 again, Tom, at the front end. 417 TK on a 2-year in America, up another couple of basis points this morning.
I'm watching standard deviations there. We're not up to breakouts. We mentioned this in the last hour. Is it breakout Thursday? Will it be breakout Friday over the weekend into Monday? But we're really buttressed right up against it. I don't know where it is on a 2-year. I'm going to guess 424.
We found a bull. She joins us around the table. Barbara Reinhardt, the head of asset allocation at Voya Investment Management. Barbara, good morning.
Good morning.
You're bullish. Why?
Well, look, we think there are a couple of things that are likely to go right. Inflation is still going in the right direction. Yields are very supportive, but have come off of their highs. That gives the PE multiple for the S&P 500 a little bit of wind at its back. But mostly we think that it's going to be the economic data is slowing enough that the Fed is able to take their foot off of the brakes and maybe take a break or a pause in their hiking cycle. And that is a very good tailwind for the equity market.
At this point, you've been perhaps painfully long the U.S. over the rest of the world, and this has been sort of a contrarian trade as everyone piled into Europe and the rest of the world. That's starting to shift around the margins, at least this week. What gives you confidence that it has staying power and that you'll basically be able to say, I was right all along, it just took a little bit?
We never say that, Lisa.
Okay,
but nonetheless, look, we think that the U.S. has some really good qualities to it, right? So the Federal Reserve was one of the first central banks to start raising interest rates. Inflation in the U.S. peaked a number of months ago. It's on the right trajectory and going in the right direction, if not fast enough for all market participants. But in Europe, think about this. A lot of bad news had been in the price in the fourth quarter of last year. A lot of things didn't happen. So not necessarily incrementally good news, but the disaster scenario didn't happen. You need things to go in the right direction for Europe to continue to work. A lot of fund managers are indeed putting assets out there. We're seeing asset allocators start to put money overseas. That's generally when the data has to really start breaking your way. If you think the U.S. has an inflation problem, Europe has a much bigger one and a much stickier one, and their central bank is much further behind the curve than the U.S. is. So at the margin, we think that the U.S. is likely to outpace the rest of the world.
The U.S. to outpace, let's be blunt. More than anyone we talk to, Voya is America first. How does a dollar fold into that? I mean, to me, the big surprise here, no one is looking for a resilient or strong dollar. John, DXY, a 103 level, BBDXY, 1236. All of a sudden, resilient dollar. Is that part of the America first story?
Well, look, you don't necessarily need the currency going in your direction in order for the U.S. to do well. I think part of it also is the visibility that you have on the U.S. is actually quite good. The U.S. consumer is holding in there quite well, even in the face of job openings coming down and some rebalancing in the labor market. So the U.S. just has more strength to it. And we think that's at the margin a relatively good thing.
So you're in a meeting with retail or high net worth individuals with Voya, and they go, we own 85% of our portfolio is Apple. What else do we do? I mean, come on, we all own Apple.
I know.
It's an outrage. What do we do after Apple?
Well, the good news is when you saw some relatively good news on the debt ceiling yesterday, you saw some of those other parts of the market that haven't done relatively well start to pick up. So mid caps, small caps, even real estate investment trust yesterday did a bit better.
Exxon is a mid cap, in case you're taking notes, John.
But I would say the thing is, if you can see some broadening of the leadership, that is a relatively good thing. But you've had narrow leadership across the entire globe, right? So what's been doing well over the past 5 months has been U.S. tech and and European luxury goods, right? So seeing a broadening out of the strength of the market is a good sign.
Just to be clear, do you expect that to continue, that broadening out?
We would certainly hope so. The inflation data in the U.S. we think is likely to go our way. And we also see that potentially getting through this debt ceiling problem is good. I would note, if the U.S. economy tends to be too strong, or if the inflation data starts to break higher, that goes right in the face of how we're positioned in our portfolios. But we think, at least for the next couple of months, things are going to go our way.
Just to be super, super clear and specific here, we know the most crowded trades, at least indicated by the Bank of America Fund Manager Survey, are long tech, short banks.
Right.
Are you leaning in the other direction then?
Look, I think you've got to be a real brave person to buy the banks at this point. But remember, we're top-down global, so I'm not making sector decisions.
Okay.
I'm positioning more in terms of countries and in terms of style tilts. So, but we think that the U.S. is probably the strongest place to be. I mean, at this point, thinking about the rest of the world, the only other place that I would probably really think about allocating to might be parts of Japan, because it looks like it's so cheap and it has a big benefit to it from the currency at this point. But for us, the U.S. is probably the place to be.
Just to tie this conversation back to what we were speaking about with Max Kettner of HSBC earlier, he was saying it's not really a sector kind of market. It's an everything on or everything off kind of market. This is why asset allocators are tearing their hair out right now. Are you finding that it's the same thing, but it's country specific, everything on in one country or one region, everything off in that region?
Yeah, I think it's more regional probably than specific countries, right? These markets can be very thin. When you have narrow leadership, you have to be on the right side of pretty much everything. It's very difficult to go into risk on and risk off positions. You have to really pick where you see the best visibility, and the best visibility for our part is in the U.S.
Right now, is big tech sort of a necessary play within that basically you have to kind of ride the big tech wave, and that's basically what's going to distinguish the U.S. from the rest of the world?
Well, we think that big tech actually did a couple of things right also. Remember, last year, all of the layoff headlines were in big tech firms, right? So big tech took a very big view in terms of trying to right-size some of their cost measurements for the difficult investment environment that specifically that segment of the market was feeling last year. So they took some of their medicine early, and then, of course, they have the benefit of this whole AI big boom that's going on right now. So, look, could tech take a breather? Absolutely. But I would say that probably the best part of it is the dynamics for them are probably a bit stronger than the rest of it because they took their medicine last year.
I'm looking at a small cap, United Health Group, and everybody keeps talking medicine, medical, health, whatever the sector categories are. Is that part of an American play?
Look, small caps have really been beaten down. Post-SVB, small caps have really taken it on the chin. You probably need to get some of these recession fears off of the table in order to go very long small caps.
What about medical across small, mid, and large cap as well?
Again, I can't talk to sectors. We don't invest that way in our funds.
How'd she get on set? You can't talk sectors?
I can't. We invest more so in terms of top-down global macro. Look, I do think that I can't talk United. I can talk healthcare. I can talk utilities. I can talk technology.
I don't want you to talk United, but talk to me about medicine, healthcare. Yeah. We're all getting older. Is this angle going to work?
Well, look at the.
Lisa's not, but
look at the cover of the Financial Times. It was all this morning about that you have to right-size pensions, public pensions, because you have an aging population. If it's not healthcare, I don't know where it is.
There we go. I think that answered your question.
It took like 4 questions to get it out of her.
Sorry.
I don't know.
Barbara, you're great.
Give her a tiny mimosa. We'll get
Barbara
you
Reinhardt
tough
there.
crowd this morning.
Of Voya Investment Management. Bullish this market. US over the rest of the world. There you go. Just pushing back against some of the consensus out there at the moment, which has been pretty gloomy. Tom, LVMH, the luxury players in Europe, up like 30% this year. Apple, up something like 30% this year. To Barbara's point, that's where the gains have been.
I don't understand it, because how many people out there can do luxury? And the answer is it's hugely aspirational. And I guess the entry point's there. People they're going to do it. That's what they're going to buy.
Oh, yeah. And LVMH are going to keep buying everyone else.
Well, yeah,
and
there's that as well.
Been happening for years.
Well,
Lisa,
it was also the big
LVMH
China play. Remember, luxury has been a big way to play China reopening without having to go and buy the emerging markets.
In a big way. In a big way, particularly for that company. LVMH, Lisa, up by 29%, Prada up by 31%, Kering up 15%, Hermes up 37% year to date. Pretty phenomenal.
Have we already baked in the China reopening trade? That's the key question for the second half.
Based on the data so far
exactly.
that we're getting from China, feels that way. Jim Bianco's got a lot to say at Bianco Research. He joins us in about 50 minutes' time. Looking forward to that conversation from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and other group of 7 leaders have begun arriving in Japan for their summit. China and Russia will be the top problems on their agenda starting on Friday. Now, Russian President Vladimir Putin continues his war in Ukraine, and a post-pandemic China is busily expanding its economic and strategic clout. Meanwhile, China's President Xi Jinping is holding his own summit. The 2-day China Central Asia Summit will assemble the leaders of Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, and Uzbekistan. Now, it's Xi's way of reminding the G7 of China's influence outside the U.S. world order. There's growing speculation that Ron DeSantis is about to announce that he's challenging Donald Trump for the Republican presidential nomination. The Florida governor is summoning financial backers for a meeting in Miami next week. While they're there, the donors expect to make fundraising calls on behalf of DeSantis. Micron is set to land about $1.5 billion in financial incentives from Japan's government. That will help the company make next-generation memory chips there. Micron will install advanced chip-making equipment at its facility in Hiroshima. Japan has been trying to increase production of semiconductors. In the UK, BT Group plans to cut its workforce by up to 42% by the end of the decade. That's when the country's largest network operator completes its nationwide fiber optic rollout. BT says the number of employees and contractors will fall from 130,000 now to as few as 75,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The president knows, and so do these leaders of democratic nations, that if you don't take care of the nation's debt, if you allow the United States to default, virtually nothing else matters in terms of what you're trying to do around the world.
That was John Kirby of the National Security Council catching up with Bloomberg's Anne-Marie over at the G7 in Japan. Forget the happy talk, the mood music, the optics, the tone. Let's talk about the numbers. The Treasury's cash balance, $94.6 billion as of May 16th, according to data published just yesterday. That's up from the day before, but compares with $140 billion at the end of last week. So that's come down a fair amount, Tom, in the last week or so. And that's what we're watching, the cash balance going into early June.
Coming down and moving quicker. Greg Villiers has a number this morning of $87 billion, down from that 90x billion number. I don't know how many billion they need, to get the coffee poured in the Pentagon and other things that they do in government. But the adults are telling us 87 billion is borderline. Keep the government open.
Everyone's saying the same thing. We won't default. President Biden said, I'm confident that we'll get an agreement on the budget. America won't default. Jamie Dimon, the bank CEOs, met with the Senate Majority Leader Chuck Schumer on the debt limit. This was the quote from him. The U.S. should not and probably will not default. Whatever it is, we'll be prepared. Lisa, that hardly fills you with confidence, does it? The U.S. should not and probably will not default. I'd hope so.
Secretary Dimon?
Yeah. I mean, the fact that we're even having this discussion and normalizing it is ridiculous. I mean, just going to put some sort of clarification on there, sort of sense of the feeling that you have broadly within the business community as well as beyond. But here's a question. Yes, get past the can-kicking exercise, but then what are the consequences in terms of funding mechanisms, in terms of reduced fiscal response? These are some of the questions that people are trying to parse out.
Anne-Marie Horton with us right now. She's our Bloomberg G7 correspondent in Hiroshima, Japan. Lots to talk to her about on debt and on running out of money in Washington. Anne-Marie, I want to touch quickly here on your discussion with Admiral Kirby. I don't want to go into a history lesson right now, but the bottom line is this is our last World War II president. He attends the Pacific Rim, and all of this is a backdrop of a failed TPP 8 years ago, whatever it was, years ago. What is the Biden Pacific strategy before we talk about the Biden debt and deficit strategy?
Well, I think today they're almost linked, right? Because part of the strategy of this foreign trip was not just to be here in Hiroshima at the G7, but it was also to go to Papua New Guinea. This is a country that the U.S. is courting, but also that Beijing is courting.
Yeah.
And then it was also to go to Australia to meet with the Quad. So he had to cancel this because of the domestic issues back home. And that is because he wants to be home by Sunday to make sure that next week he can be there to get this over the finish line. So I do actually see these stories together, but over a bird's eye view of what the United States is trying to do in the Asia Pacific is really this, what they would now call de-risking, not decoupling. That's the new word du jour for the G7 leaders, de-risking from China and making sure they are building these alliances in the Asia Pacific.
Right.
They're going to talk about economic coercion when it comes to China. Is it just language? Are they going to actually put details to it? They'll likely point to this deal they just did with Micron in Japan. But this is part of what the U.S. is trying to do. But they want to do it in a multilateral form. And what I think is really interesting at this meeting is to see how the Europeans play with the United States when it comes to Beijing.
When the president gets home, and there's always that drama of, you know, the glamour of the G7 and hanging out with Amory Horton and all that, and they get back to boring Washington, they come off the plane, and they have to de-risk with, in this case, the Republicans. How will the president of the United States, with all of his legislative experience, de-risk with Speaker McCarthy?
Well, I think he's trying to do it now by cutting his trip short and making sure he's getting home. Because right now what McCarthy is doing is almost winning when it comes to the public opinion. What you see out there saying, why is the president traveling? Why didn't the president meet with me sooner? Then he wouldn't have had to cancel this trip. They want to make sure that they can get this done before June 1st. Admiral Kirby there saying that obviously foreign leaders do not want to see a default in the United States. Obviously, that would undermine the entire global financial system. So the president really has aides around him here, updating him what's going back in Washington. And then he's going to have to go home and seal the deal. But of course, negotiations are happening. The negotiations have narrowed, but we still don't have a firm deal that we're going to see pass Congress at this moment. So there's a lot of work that still needs to be done on the debt negotiations.
Anne-Marie, we're getting some contours of what that deal might look like, and work requirements are looming large over everything. Can you give us a sense of what the Democratic pushback is and where this is?
So the president spoke about this before he left for the G7, and he seemed to be really against work requirements when it comes to access to health care and health insurance, but didn't talk about others, like potentially groceries. So there may be wiggle room when it comes to work requirements outside of the medical space. That is one area we're watching. The other thing, of course, is Republicans are really digging in their heels when it comes to unspent COVID funds, when it comes to energy permitting. So there's going to be a lot that the Republicans are really trying to get the Democrats to cave in on, because at the moment, the only bill that has passed one part of Congress in the House is Speaker McCarthy's bill. And that does raise the debt ceiling, but it comes with measures that Democrats say are just draconian.
We've been talking all morning about how the mood music has improved. Has the mood music among the people who actually know what the negotiations are like improved? I mean, do they really sense that there has been a shift, or is this basically just happy talk from the leaders to try to play to their political base?
Well, I think it's important when leaders come out and they say we will not default. That does mean that they want to get to this finish line. I think one thing that a number of individuals, and you hear from individuals in Congress talk about, that not just Democrats are taking notice, but the White House is taking notice, that Speaker McCarthy, everyone was pointing to as someone who was not going to be able to hold his party together, to hold the entire 218, his conference together, because of the 15 rounds of votes he needed to become Speaker. And I think a lot of people are looking at him and saying he's been able to hold his conference together, and he has a great deal of leverage in these negotiations, which is why I think they are feeling very tough at the moment. But the fact of the matter is the negotiations have narrowed. The president cut his trip short, so the White House is determined at this point, as you can see, to get a deal done.
There is that hope. It's out there. Anne-Marie, thank you. And can I just say again, just wonderful coverage out there, just to kick off things at the G7 in Japan with Anne-Marie Horton going into the weekend. The president will return. there will be some hopes out there still that we have a framework for some kind of agreement laid out by the staff level talks that will continue into the weekend. We'll keep building on this. But ultimately, Lisa, you want to hear some real fundamental progress instead of just things are going to be okay, we're not going to default, which is kind of mood music type stuff, to your point.
Yes, correct, which is the reason why people haven't totally taken it off the table, because they know how things go in Washington. It feels good until it doesn't. But at the same time, there's then what next? What do we worry about after that? Is it possibly how we fund this? Is it possibly, China, U.S.? I mean, this is sort of the issues that people are looking for right now and not getting the all clear kind of signal.
I look at where we are, and I'm going to go back to fundamental macro and our star, John Williams, Tom Laubach, and the rest. And the answer is, John, this whole shell game is based off a reduced R-starred, and there's a raging debate in economics about, do we continue forward with a low interest rate, low Fed rate regime that can keep this debt and deficit shell game going, or is it a whole new world after all where we got things to worry about? Nobody knows.
Well, we found the bite point in the regional banking system, haven't we?
Interest
rates.
Rate of change on interest rates.
Have we found it in the U.S. economy?
It's a really important question, and I think a lot of people would say is move from a nominal analysis to a real analysis. And when inflation comes down, let's say you get a David Rosenberg, Ed Hyman disinflation, nominal GDP comes down, and that's like in Buffett's language, the water moving out to see who's wearing swim trunks. And the answer is, it's going to be interesting to see as we have disinflation which way that ambiguity cuts. We don't know.
Let's talk about Walmart. Walmart's doing well. Is that a good thing for this economy? Walmart's up by 1.5% in the pre-market.
Dump on Bentonville, Arkansas this morning?
We're going to build on some of their numbers.
We should do a remote there, the
it's
three
a
of
good
us.
question.
A lift to their outlook. The average ticket is up. Transactions are higher. They seem to be taking business from elsewhere, Lisa. Walmart's doing well.
It's a good question that you ask. Is this good for the economy, or does this mean that people are downshifting from whole paycheck, as Tom likes to call it, to Walmart? And that's really the issue that people keep talking about.
Remote down there, we could get members of the Walton family on to,
that would be
talk
cool.
up, talk up the future of Walmart.
We should do that, yeah.
We should do that.
Whole paycheck is getting so expensive. It's like 2 paychecks now.
Now it's like rent
nuts.
in New York City.
It's like, yeah,
it's
close.
like another rent. There you
Rent
go.
in New York City, eh? Equities just about positive on the S&P 500. You don't want to know what we were talking about in a commercial break. Deadly stuff. Deadly. Cereal.
I just top-ticked
cereal
Whole
in the
Foods.
morning.
John, I went to Whole Foods and paid more than I've ever paid before. I mean, that's that inflation thing going. And I'm not buying stuff Lisa's buying.
It's ridiculous.
Bramwell's buying gluten this
That's
and
nuts
gluten
how
that.
expensive things are.
Yeah, well, I would agree. But the problem is that, you were saying this, to eat healthy is so much more expensive. And it's a huge issue, because how do you feed a family in a healthy manner if you are constrained on the paycheck front?
You sit down for a box of cereal, which I just believe is cattle feed for humans. It's just terrible.
Did you ever see the Jerry Seinfeld Saturday Night Live? Where he basically said that
I know Seinfeld.
he was doing like nightly news, where he basically was saying like,
but I appreciate the clarification.
Something is coming up. It's going to kill you. It's in your household. We'll tell you after the break.
Let's
Cereal.
get to the bond market. This won't kill you. 2-year, 10-year, 30-year.
It's been known to do that.
Who knows? Yields are higher by a couple of basis points, up on Monday, Tuesday, Wednesday, up again this morning, going into claims about an hour from now. 4.18 on a 2-year. On a 10-year yield, we're higher by 3 basis points, up to about 360. I've just got this image now. Someone's sitting down for cereal right now, watching this, and they're just like, screw you, Ferro.
Throwing the cereal at the screen.
Enjoy your Cheerios, all right? In the FX market, we look like this. Euro, just a touch weaker, just holding on to 108. I find this really interesting.
I agree.
This slow grind.
Strongly agree.
This slow grind, just chipping away at this short dollar story, Tom. 108.11 on the euro against the dollar.
A 107 handle to the FX pros out there. How distant is that from 105, where we start a parity chat again? I'm not saying we're going to do that, but all of a sudden 107 handles, not a 110.
Things change, and then 106, and the data's going in that direction, Lisa, and I think that's what's interesting about this. Not all at once, and I've said that a few times this morning, but just slowly, just chipping away at it.
And how much does this completely upend a lot of the bets that were the most popular in the first half of the year? Taking a look at some of the stocks, the reason why we were talking about cereal is because of Walmart, believe it or not. The fact that it had better than expected earnings and those shares up almost 2%. This had to do in part with their grocery business. In other words, how much are people going there rather than Whole Foods, Whole Paycheck, whatever you want to call it, because of how expensive things are getting. Again, is this good news or bad news for the U.S. economy, John? You've been asking that, but we have seen upside beats in so many of the retailers. Cisco, a very different story. Those shares significantly lower, at one point down significantly more than this, now 3.7%, retracing some of that. They said that there was a sharp decline in orders in the past quarters that offset a positive sales forecast, people looking at demand and not really seeing it there. That's a separate story. Western Alliance, now this is interesting, and I know I'll get eviscerated for quoting the percent change. It's up almost 4%. It's nothing based on how much it's fluctuated around.
You're okay. No one's going to say a thing.
That's not true. But anyway, moving forward, yesterday, this builds on the rally we saw yesterday. Regional bank stocks had their strongest rally in 2 years yesterday. And all it took was Western Alliance coming out and saying, we got some deposits. And everyone's like, yay, it's over. And that seems to be where we are this morning as well.
Relief rally, squeeze, call it whatever you want. Just got this from a terminal subscriber, won't name them. They said this: if cattle feed had marshmallows, the cattle would be happier.
I like
marshmallows
that.
in your cereal.
Okay, I grew up with
you?
that, and I've got to say, if you eat Lucky Charms, you have to eat the oats first, so you let the marshmallows sit in the milk to get soft, because they're kind of cardboard
John,
when they come out, and then they're good.
I like the nutrition things. I actually look at them, and I just did this, John, for Walmart to add on to Lisa's important report. Fruit Loops. Have you ever had Fruit Loops, John?
Sure.
$4.98 a box. I'm sure that's a Walmart price. 24% of your daily sugars in a 12-ounce, an itty-bitty,
but low on fat, yay. But that's the thing that does my head in.
24%.
You said it's the sugar lobby.
You start, but what's important here is Ian Lincoln gets up in the morning and slams the Fruit Loops down at 4 a.m. before he writes the bond note, and he's 24% to his daily sugars right there. What do you do with your beverage of your choice late at night?
Orange
that gets
juice.
up to 140%.
Orange juice. You want orange juice and Fruit Loops.
Why don't you bring
it's good for you?
I love this.
Good for you.
He's worried about having too much sugar intake in the morning for the beverage of the choice in the evening to save it for that. All right.
I'm saving it for the beverage of my choice. John, bring in our colleague here on the healthcare show.
This is what Ian's got to say from BMO. Not on healthcare, on the Federal Reserve. Incoming Fed speak is consistent with a committee contemplating a pause in June. We're expecting the next 4 weeks will settle this debate in favour of no hike and thereby allow the cyclical steepening of the curve to commence. TK, this is an interesting take because they're contemplating this pause, not committed to one, and they're actually going some way, making the effort, I think, to remain open to the idea that they might hike again at the same time, which has been interesting this week to witness that.
Red on Global Wall Street. Mr. Lincoln joins us now with BMO Capital Markets. Let's take it over to a bond guess from the Econobabble, which is if you get a pause in the Econobabble, is it asymmetric, means they're going to cut, or is it truly symmetric? And how does the bond market react to a symmetric view of a pause?
Well, to your point, Tom, I think a symmetric view of a pause is precisely what the Fed is trying to communicate at this point. Up until this stage, everyone believed that once you hit a pause, that it was terminal, the next logical move would be a rate cut. We can see that that's still priced into the bond market even at this point. We have 58 basis points of cuts by the end of the year. That suggests that the market does not believe in the market does believe in the asymmetry, doesn't believe that a pause is just a pause.
President Mester had this to say this week, that she does not believe it's equally probable that the next move is a cut or a hike, leaning into the idea that the next move could well be a hike. Do you not share that view?
I don't think that we will see a hike. I think the Fed actually is at terminal. What I'm very sympathetic to is the Fed's looking at the futures market and saying, we want to remain on hold well into 2024, and to avoid a market disruption between now and the end of the year, let's convince the market there is a little symmetry around terminal.
What's on your dashboard right now, just in terms of the economic data, that suggest, give you evidence, just a couple of signs that we are at terminal and this is the right place to be? This is sufficiently restrictive, to use the Federal Reserve's phrase.
I think the one piece of data that we're looking at that is very convincing is core services CPI, ex OER, and rent. Now, the Fed has told us to look at that measure as ex shelter, but that that includes the hotel component. So the real core services number is actually at just 0.1.
So a bunch of words there. Can you explain to all of us what that actually means? What are you tracking there?
So within there, all we've done is we've looked at what real inflation looks like, excluding what it costs to live in a home. And I think that that's how the Fed has told us to view the forward trajectory of realized inflation.
Where's Walmart on that dashboard of yours?
So I do think the earlier observation that was made regarding the rotation out of higher-end retailers into Walmart is a typical into-the-cycle transition that certainly resonates when we think about the fact that real wages have failed to keep up with inflation. The fact of the matter is real purchasing power has declined over the course of the last 24 months.
But if we have, Lisa, if inflation comes down, are we going to lower wages? That's never happened. We're not Britain. The answer is wages are going to stay up, and all of a sudden real wages are pretty good if inflation comes down.
Well, it's the pace of wage increases as well, and whether they can continue to go up at the same level. And this is something that people will be parsing through. But to build on what you were talking about with respect to the consumer and the resilience and sort of the downshifting, the gradual downshifting, what we've heard this morning, whether it's Barclays, what we're going to hear from Ellen Zentner of Morgan Stanley, is this idea of a soft landing, and that it's becoming more and more likely as we do get a slow grind lower, not a sudden fissure. Are you in that camp? Are you growing sort of accustomed to a this time is different kind of feel?
Well, I think it's useful to add the context that hard landings and soft landings look the same in the beginning. And it's not until you actually hit an inflection point that people look back and say, oh, actually, that was a hard landing. And the inflection that we're looking for comes in the form of the jobs market. The Fed has told us that they're expecting that the unemployment rate will end 2023 at 4.6%. If we look historically, that's very unlikely to happen because any time the unemployment rate is more than 0.3% off the cycle low, it spikes by 300 basis points, not by 75. And so that means that once that inflection hits, we're going to see companies snowballing, saying, okay, my competitor is laying people off, I'm going to do the same, I'm not getting punished in the equity market to do that, and that's where we end up at a 5.5 unemployment rate, and that's something that's going to get the Fed to move.
I got to make some money this morning. I need to buy some Fruit Loops at Walmart. They're crispy loops with fruity flavors.
Nice.
Thank you. And to do that, I've got to make a duration call. What's your duration call now? Do you extend duration? Where's the most efficacious play in the curve?
So at this moment, we're very interested in 5s, 30s re-steepening. Now, we got above 40 basis points. We're now back below 27. A move to 50 or 55 basis points.
We'll buy a lot of Fruit Loops.
We'll buy a lot of Fruit Loops.
Okay, I just want to be sure of that.
What is it about the 5-year piece of the curve that you like versus, say, playing it through the 2-year and further out? What is it about the 5-year?
So 5-year gets us through the current cycle. It gets us through a period where the Fed emphasizes retaining terminal for an extended period of time, and the market is content to look at what happens when the Fed, even if it is a soft landing, still needs to cut rates in 2024 and 2025. And embedded in that is the idea that the Fed will be successful in bringing down forward inflation expectations. And even from a technical perspective, the 5-year sector at 360 starts to look pretty cheap.
Implied by that call also is this idea that maybe we go back to low neutral rates, right? Isn't that your call too?
Yeah, I think that, as you said, implied by our kind of forward forecast in this environment is the assumption that if inflation is structurally higher, it's only structurally higher for a specific period of time. And as long as the Fed's committed to that 2% inflation target, they're going to bring us back to a lower rate environment going forward.
Interesting call. Ian, thank you. Ian Lingen there of BMO Capital Markets. Thanks for being with us. TK, some fascinating stuff there. There's so much embedded in that call, 5-year, 30-year steeper. When you really start to think about it, there's a lot of assumptions baked into that.
And this is what Bramo did for years with Bloomberg leading the bond coverage. I mean, it's not just the 2-10 spread. There's a lot of information in different spreads. Right now, I'm focused on the T-bill spread, T-note spread, the 3-month 10-year. But, you know, a guy like Lingen, I mean, he's got 6 of them tattooed on his left arm.
Well, T-bills right
It's
now.
got 10s, 30s, and
as Lisa
5s,
knows,
30s, and
T-bills right now are a mess, aren't they? Particularly over the next month or so.
So they've been the ones that have been most reacting to the potential for some sort of debt ceiling debacle. And that's come off just a touch. But then what happens after that if they issue more T-bills in response to some of the funding mechanisms? I mean, there are a lot of vagaries here as well after that hurdle gets leaped over.
Have we finished the healthcare segment? Are we done? I think we're done.
I
He's
had
not
no
done.
idea.
We're
He's
never
so
done.
not done.
Fruit Loops has red 40 in it and yellow 5, I think it is.
What is
and
that?
Blue. It's food coloring.
Nice.
My sister lived on Fruit Loops for like 4 years. That was like that was her major
Like bouncing
food
off
group.
the walls.
You know.
I'm sure. Joe Feldman's going to join us shortly of Tausi on Walmart and the retail sector. That's coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Walmart is raising its annual profit forecast after posting better than expected earnings in the first quarter. Comparable sales easily beat Wall Street estimates. Still, Walmart expects shoppers to remain under pressure this year. President Biden is in Japan for a Group of Seven summit on Friday in Hiroshima. Leaders have a number of challenges ahead of them, including how to enlist nations outside of the group, as many countries have resisted sanctions on Russia due to the pressures on their own economies. There's also the question of how to handle China with its perceived economic coercion. Meanwhile, China has kicked off a European tour aimed at brokering peace in the war between Russia and Ukraine. A top Chinese diplomat met with Ukraine's President Volodymyr Zelensky this week. Li Hui told Zelensky that ending the war would require all parties to build up trust. Ukraine has said it won't accept proposals that include the loss of territory. President Biden hopes to be re-elected next year by defending his victories in 2020 battleground states. But he also wants to expand the map into states like North Carolina and Florida. In a memo obtained by Bloomberg News, campaign manager Julie Chavez Rodriguez argued that Democrats strengthened their hand with their performance in midterm races and in this year's special elections. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Companies are passing on costs, as is sort of legitimate to their customers, but then they're using that as sort of a cover story to convince their customers to also accept a profit margin expansion. In certain sectors, and again, it's not everywhere, but in certain sectors they've been enabled to expand their margins, but we are starting to see the consumer fight back.
One of the best communicators in economics, Paul Donovan there, Chief Economist at UBS Global Wealth Management, has a different point of view on a range of things, but TK always dresses it up so nicely with different stories. I just enjoy listening to him every single time he comes on the show.
I think it's a legacy of George Magnus. UBS did this. They had Jonathan Anderson in China, who owned the high ground on the study of China away from the easy-to-study Pacific Rim shore. And the heritage of the Union Bank of Switzerland was wrapped around John Anderson, George Magnus, and this young kid, Donovan, who now is the eminence grisée there and really doing smart 15-page essays. And you read them.
And George transitioned to becoming like the guy on China.
I read his book. I read his last book, cover to cover. And these guys, I mean, this is
what was
the
that? Red Flags.
Yeah, brilliant. I couldn't remember that. And folks, this is really important. All these firms have a different character, including Telsey Advisory Group. And the answer is they have character and they have a style. And Paul Donovan's representing that now at UBS.
Well, before we get to Telsey, let's get to Walmart and talk about retail just briefly. The stock is up in the pre-market by 1.5%. They've raised their outlook for the full year. A bit softer than anticipated for the second quarter, but we saw a little bit of that yesterday from Target as well. But then they committed really to the full year outlook. A lift for Walmart. Walmart 152, let's call it, Lisa, in the pre-market, up by 1.6%.
And this is really a theme that we keep seeing. There is resilience and there is an ability to pass along price increases far beyond what the input prices show. So Walmart, yes, perhaps people are trading down, but there's also an underlying strength fueling potentially future sales.
Well, that phrase is important, Tom. How much of this is just trading down from elsewhere, taking business from other retailers.
I like what Ian said there. It happens all the time. It's the theory. You know, things get tough, and for a lot of America, it's tough right now. Let's not forget that. And people trade down. To give us perspective here, working with Dana Telsey always, it's Joseph Feldman, just really quite good. Terse reports. What did you do? I mean, let's get out front of your research. I need to front run you and Dana this morning. Do you change your view on Walmart with this optimism we're getting in the last hour?
I don't think so. I think you want to stick with Walmart here, especially in the environment we're in at the moment. And, you know, we're hearing from so many of the retailers that there's a lot more concern about the second quarter, concern about the economy, what it's going to look like in the second half. And in tougher times, Walmart tends to shine.
Dana was legendary at Bergdorf Goodman as a kid. She was like 12 years old, and if somebody was caught shoplifting, they had to babysit Dana, you know, for years. Joe Feldman on shrink, on the theft we saw with Target yesterday. Is there shrink at Walmart?
Yeah, there's absolutely shrink happening at Walmart. They haven't called it out quite the same way Target has, but you know, all the retailers are dealing with the shrink issue, the theft, organized crime. It's a big deal, and I think it's a big part of the equation for a lot of the retailers. It's a big number, maybe less as a percentage of the overall total sales for Walmart, but the dollar amount might be as high or if not higher, I would think, at a Walmart relative to Target. And it's not just these two. Again, this is across retail, and the retailers really need to work with local authorities to find ways to try to stop this, because the current way to do it is you have to lock down a lot of product in the stores, and it makes it for not a great shopping experience for the consumer. It really feels uncomfortable for those that are not there for theft. They just want to buy stuff.
Putting that aside and giving the fact that this is going to be a policy consideration going forward, there is a question about what period we're in. You said these times that we're in. What times are we in? Are they at one of strength with the consumer having spending power or not?
So it's been very confusing. We're getting lots of mixed signals. We believe the consumer is a bit stronger than most, you know, otherwise believe. The reason I say that is, you're seeing spending on consumables, household essentials, basic items. People are keeping, you know, their food on the table and keeping the house running. At the same time, you're continuing to see increases in sales at dining out, entertainment, going to sporting events, travel. All of those, you know, service-oriented economy is still actually doing fairly well. I do think we're going to see spending slow a bit, broadly speaking, but those pockets of the economy right now would sort of indicate that the consumer still has some money to spend. Now, I agree, they're not spending on discretionary goods, and we don't expect that to pick up much this year. I think you're going to see more of the same, and then you could start to parse it out by income level, where the higher income people are the ones that are really spending on the services. The low to middle income, they're the ones just focused on getting food on the table, keeping the household afloat.
In Walmart's earnings, it's kind of a microcosm of the broader story on a lot of fronts. You've got people who are downshifting perhaps to grocery, and grocery certainly does account for a significant amount of volume, but the profit really comes from the other areas, and you can see that the margin is expanding there like it is at other companies as well. In other words, the input prices that they experience, they can pass that along and then some, and consumers will keep buying and buying more than expected. How long can this last, that they actually just can increase their profit margins and just expect the consumer will eat the price increase?
I think what we're seeing, a lot of the profit margin increase from Walmart and some of the others, it actually relates to greater efficiencies and getting better leverage. And if you look at comparisons from a year ago, supply chain costs were through the roof. Those have come down pretty significantly. So that is providing some cushion. I think, you know, as far as food and consumables and basics go, Walmart especially passes things through pretty quickly. So as prices have been moderating, which we're hearing inflation is starting to moderate on that side, they're passing that through.
Joe, CFA 101, you got a single-digit nominal GDP grower. They're bringing pennies down to the bottom line. And I'm enjoying a forward view on Walmart of a 24 multiple. You got to be kidding me. How do you, really, with great respect, how do you and Dana adapt to a 24 multiple on the biggest aircraft carrier in the water going through the water at 4 knots?
Well, it's a big aircraft carrier that's becoming sleeker. They're doing more with higher margin businesses, advertising, online. They're transforming. They're kind of meeting in the middle with Amazon. If you think about it, think about the valuation that Amazon trades at. Walmart has gotten a lot more efficient with their online business. They've grown that. They have a marketplace very much like Amazon, which is highly profitable. They've got more third-party sellers coming on. So there's a lot that Walmart's doing to kind of borrow from the Amazon playbook that would argue that they are becoming a more dominant and more important retailer, building their ecosystem in more profitable ways, and therefore require, or would warrant, maybe not require, but warrant a higher valuation.
Interesting. Joe, we've got to leave it there. Thank you, sir. Joe Feldman there at Towsey Advisory Group on Walmart. Their stock is up by 1.8% after raising their outlook. The average ticket increased, transactions higher, raised their outlook. Everything okay on that front this morning. This is Citi's Andrew Hollenhorst, just publishing again this morning. Had this to say. Keeps building on this theme at the moment. The hike probability is rising as Q2 real GDP growth looks increasingly likely to come in stronger than Q1. Yeah. I don't know how many of you saw this yesterday. I know a lot of people wrote into me to talk about it, but the Atlanta Fed GDP forecast, do you know what it is now? Just shy of 3%, 2.9% so far.
I don't think this is a small matter, and it goes back to the legacy of this show, is we've been hearing people talk recession for 18 months? Am I wrong? 18 months, and we're going to get double back-to-back 2%, 6 months of 2% growth. That wasn't modeled in.
Well, but the problem is that the response function to that, we don't have clarity on, right? We don't know how much this ends up in the sort of tail risk of a resurgence in inflation that then causes even higher rates. People have been whipsawed all over the place, and that's what we heard from Barbara Reinhardt of Voya Investments. She came out, she said, that would be against our positioning right now because we're not anticipating that. Nobody was just a month ago. It creates a real pain trade.
Let's see what claims bring in 35 minutes. Then on to Chairman Powell on Friday, Tom.
June 2nd, Jobs Day.
Yeah.
And what are they going to do to Hollenhorst? The idea of rationalizing a quarter-point increase. What are you going to do with an unemployment rate 3.4%? Where do they model it? They don't have enough information how to model it. I get it, but we're miles from 3.8, 4.1%. We're miles from that.
There is a belief they pause in June still. That was the belief in the immediate aftermath of the news conference with Chairman Powell only 4 weeks ago or whatever it was. We had that conversation on this programme that morning, Tom. But, Tom, you asked the right question that morning. What kind of data would it take to reintroduce the prospect of a real move in June? Alicia Levine was great yesterday on this programme from BNY Mellon. It feels like they're sort of pretending that they're open to going again in June. But ultimately, what if it is live? What if it is? What kind of job number would you need in early June, Tom?
That'll be it.
Jim Bianco of Bianco Research joining us next. I believe he's in New York. Very cool.
Really?
Certain sectors, you're getting an expansion of profit margin, which has led to the inflation that we've had over the last few months.
The message from earnings season is that there's still inflation in the system.
Yes, inflation's come down. Has it come down nearly as quickly as the central bankers would like to see? No.
Once the Fed stops easing, then we'll see the strength return. It's really pretty well balanced.
We got this chill, cool duck hanging out on the surface, furiously paddling underneath, and that's the equity volatility bid.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Amy Wu Silverman there paddling the duck, and the duck this morning is a duck of optimism, John. Optimism in the air. That's the message.
An optimistic duck, is that what you want to say?
It is.
That might be the message, but the market so far over the last month has been a bumpy road to absolutely nowhere. We've talked about these numbers a few times, that on Tuesday we had the biggest one-day loss since May 4th, and then Wednesday we had the biggest one-day gain since May 5th, and here we are in the S&P still struggling to break out of a range. For the economic data, front and centre, about 29 minutes from now, we're going to look at jobless claims. 264 is the previous number. 251 is the estimate in our survey. Let's see if that comes back down. Certainly a theme over the last couple of days, pushing out the recession call. Undercurrent, Reid Pickett here at Bloomberg did a wonderful job, Tom, of really outlining the story at the moment, which was recession, and then kind of like let's push that out a little bit further.
And also, there's this gloom about what's going to happen. The world's going to come to an end. I think there's a consensus view that earnings for the first quarter, we're wrapping up retail now, and Walmart. Lisa, you mentioned, I'm sorry, Walmart, is the right phrase better than good?
It's better than expected, and they've got an upgrade to their forecast. But it's not just Walmart. It's Bed Bath & Beyond, which has been left for dead. They came out also.
Quite literally.
Literally left for dead. I mean, they were supposed to go bankrupt and then get sold off and liquidated. They beat expectations and upgraded their forecast. It's everyone. So at what point are we looking at not perhaps, as we were talking about yesterday, the lag effects of the Fed hiking cycle, but the lag effects of the stimulus that was injected into the system during the pandemic?
What did we get out of Ian Lincoln? John, summarize from Ian Lincoln. I mean, the guy's world famous, acclaimed, and all that.
Well, what I heard from him, Tom, to put it simply, is that he shares the idea of the IMF, which is that rates go back to pre-pandemic levels. And that's embedded in his call that he thinks you get a steeper 5-year, 30-year. He wants to take out the effort of the Fed right now, which is why he wants to start with the 5-year and look for 5-year, 30-year steeper, because he thinks ultimately over that time horizon, 5 years out, rates are going to go back to where they were before.
Lisa, this is a hugely important theme in that the Bloomberg Total Return Index, the aggregate index, negative 17%. We've never seen it in our lifetime, no question about that. And the adults like Lincoln aren't looking at 3-month paper or the kinks because of the debt ceiling or that. They are having the courage to look out and bet on duration, which means price up, yield down.
You asked a really good question earlier, Tom, which is, have we found the terminal rate? Have we found what the new R-star is, where we've got this sort of optimal Fed funds rate? And we don't know, right? And this is really the big question mark, because we don't know if this economy is responding or slowing enough to a 5% Fed funds rate. What does that tell you about where that neutral rate really should be?
26 minutes away from claims. Is McKee with us today, or is he in transit somewhere?
McKee's with us.
He's with us?
Yeah.
Very good.
In New York himself.
Two-year yield, John, 4.18%, up from 3.85%. 2 cups of Sanka.
Getting closer to 420. Yields higher every single day this week. I'm going to skip the market check and get straight to Jim Bianco, president, founder of Bianco Research in New York. Love this, Jim. Good to see you.
Good to see you in person.
Are we mistaking inflation for retail sales? Your question, are we?
I think we are. If you look at retail sales and you look at the gains, because we look at it nominally, and if you take out inflation, we haven't done anything with retail sales in 2 years right now. We've been trending sideways. So when you see the 0.4 of a gain in April, remember that we also had 0.4 of a gain in inflation. So it was just really the price increase. And we're saying that was the increase in retail sales. But net, there was no new units being purchased. I might add that if you look at things like UPS and stuff, they're telling you unit sales are kind of been stagnant as well, too.
So when you look at the temperature, or rather take the temperature of the U.S. economy right now, what do you find?
I think we're back to where we were pre-Silicon Valley, because pre-Silicon Valley, when Chairman Powell spoke, he talked about a strong economy. We were talking about 6% inflation. 6% funds rate, because the economy was, remember the phrase no landing? We were back to no landing again. Yeah. And so we're kind of back to that mentality, but we still have this overhang coming, and that is, what about this bank walk? What about the turmoil in the banking system? What about when we get the debt ceiling resolved and $1 trillion of Treasury bills are going to be issued that's going to suck reserves out of the system? Does that drag the economy down later this year? But not now. Right now, it has this feel of early March again.
In my chart of the week, without question, is what John was talking about. You've got our retail sales going up, Walmart good, and the rest of it, the luxury that John talks about. And the actual inflation-adjusted retail sales are flat. But corporations think in the nominal space. Are you saying lighten up on the stock market?
No, I think what I was trying to say with the chart is that when people look at retail sales and they want to gauge the health of the consumer, on a unit basis or on an after-inflation basis, they're not making any ground. They're buying the same things for the same price.
Yeah, but to our listeners and viewers, it says Jim Bianco says lighten up on stocks. Are you saying that?
I'm not necessarily saying that. I'm kind of, aggressively neutral on stocks right now. I think that they're going to trend sideways. My bigger theme
my third divorce lawyer said that. Continue, Lisa.
I was going to say my bigger theme on the stock market is I think we're going back to something like the 80s and 90s. We're going to go back to like a stock-picking, rotational type of of market. It isn't so much, is the S&P going to go up? It's which sectors and which stocks are going to perform.
What does aggressively neutral mean? Seriously.
It means what you see the chart over the last year. If you look at a chart of the S&P over the last year, it's gone sideways. It's the same place it was in May of last year, last fall, and it's in January. It's at the same point that it was. And we just kind of meander sideways. It doesn't go up. It doesn't go down. Even yesterday's big rally took us to the highest levels we've seen in a week. And so we don't go anywhere. There's really no trend. That's what aggressively neutral means.
Does this account for recession, or is that basically increasingly not off the table, but looking less likely?
I don't think it's looking less likely. I think it's not evident now. Ask me in the fourth quarter, where are we with the banking situation? If the bank walk, let me define that. People are saying, I'm going to take my money out of a 1 basis point yielding Chase account and I'm going to put it into a 4.8% yielding Chase money market fund. And if hundreds of billions or another $1 trillion comes out of the banking system little by little by the fourth quarter, we could have a real credit crunch on our hands, and then we could be talking about a significant slowdown in the economy. We don't have that here in May. What we have is something that looks more like March. And I think a lot of people are trying to dismiss what's been happening with the banking situation and thinking it's not a big problem. I'm not there yet. I still think there's still chapters to be written in that story.
You've said that a few times about being back at early March. 2 years about, let's call it 90 basis points south of where we were in early March. As you indicated, Chairman Powell was opening the door to 50 basis point hikes, and we were talking about 6% Fed funds.
Right.
So how are you thinking about Fed funds now and the path for the Federal Reserve, given what you've just said?
Let me throw in another nuance on it. I think that inflation is going to bottom for the year within the next 60 days because there's a gigantic base effect coming with the inflation numbers. Last year, May was 0.9. Last year, June on inflation was 1.2. When we take those numbers out and replace them with about a 0.4, which is what we've been averaging, we should be in the low threes on the inflation numbers by July when we get the June number, and that should be the low of the year, and it should start drifting higher. So I think what Chairman Powell is going to look at is he's done. He is basically higher for longer. He's at 5%, and nothing short of a full-blown recession, I think, is going to get him to cut rates.
Do you think then we're going to slowly chip away at what's priced in this market, or do we do that all at once? How do you foresee that gets priced back out?
I think we're going to slowly chip away. I think we're going to find that the majority of job creation in this country is companies of less than 500 employees. Those companies do rely on small and medium banks. If those small and medium banks are impaired in any way to give them financial services or loans, that is going to be the chipping away at what we're going to see with the economy as it slows. And they're going to be impaired because their deposit base, they're unsure about it. It's going to money market funds. They're not quite sure what their lending capacity will be or the profitability.
This is what Oxford Economics had to say as well. They agreed with you, and they said that they think that the banking turmoil begins perhaps a prolonged downturn akin to what we saw with the S&L crisis in the 1980s. Does that bring inflation by itself down to the ultra-low rates that we saw pre-pandemic? Do you agree with Ian Lingen's view?
No, Ian's a friend, and I'm going to diverge from him a little bit. I think we're in a new, I used my fancy word, post-pandemic economy, which means that we are in a higher inflation environment than we were pre-pandemic. We're in a 3, maybe 4% inflation environment, not a 6 or 8% inflation environment. And as we go forward, we're going to learn this is a very different economy than it was, say, 2019. And it has more frictions and it has more pricing problems than we've seen before. Now, eventually we'll restructure the economy and wring that inflation out, but that's going to take several years.
Jim, you're going to be with us for this half hour, which is spectacular. We lost Robert Lucas, who's a giant. And what a privilege it was to interview him another time. Truly the giant of rational expectations, of questioning modern economics. Greg Mankiw said he was the single most important economist of the modern age. He wanted us to be rational. Out of a pandemic, are we rational in our expectations, or are we just making it up as we go? To me, there's very little theory going on here.
No, I think we are very rational. I think what we're doing with the banks is very rational. I think that our attitudes about work and remote work are somewhat rational as well. We needed a catalyst in order to maybe make us act on that rationality. That catalyst was we sent everybody home for a year, and then they said they kind of reassessed what they wanted to do but was afraid to do. And I think we are acting rational.
Who's got it right at the moment? BlackRock get back into the office or Deutsche Bank, who are seeking to cut office space by 40%? Who's got it right?
That's the question of the day.
I think all the BlackRock resumes are going to Deutsche Bank right now. and that's going to be the big push-pull between the firms that, I mean, is there a competitive advantage now by throwing that out there that we have remote work and they want you back in the office 4 days a week?
They got this hybrid model over at Deutsche Bank, which means you have to come to the office, or rather, you go home 3 days of home office per week, right? 2/3 of employees have registered for that hybrid work model. 2/3. Which has meant they can slice office space by something like 40%.
Lisa, help me here. I have no wisdom on this at all. I have no idea where we're going.
It all changes when the labor market changes. If it doesn't get looser, then you know what? You're going to have this exact same kind of calculus.
Jim Bianco research on the debt ceiling, coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Walmart is raising its annual profit forecast after posting better than expected earnings in the first quarter. Comparable sales easily beat Wall Street estimates. Still, Walmart expects shoppers to remain under pressure this year. President Biden is in Japan for the Group of Seven summit on Friday in Hiroshima. Leaders have a number of challenges ahead of them, including how to enlist nations outside of the group, as many countries have resisted sanctions on Russia due to pressures on their own economies. There's also the question of how to handle China, which has perceived economic coercion. Meanwhile, China's President Xi Jinping is holding his own summit. The two-day China Central Asia Summit will assemble the leaders of Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, and Uzbekistan. It's Xi's way of reminding the G7 of China's influence outside the U.S.-led world order. The state of Montana has now banned TikTok. That sets up the first legal and logistical test for broader efforts in the U.S. to restrict the widely popular video sharing app. The Montana law prohibits app stores from offering the app to people in the state, but enforcing the restrictions for current TikTok users could be more complex. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
It's the perfect Goldilocks backdrop where it's a bit of food for thought for the Bulls, a bit of food for thought for the Bears. You know, the rate cuts are not being priced out yet because we particularly see U.S. headline inflation go towards 3% in the next couple of months. So, you know, you've got mixed data, but data on aggregate beating expectations, but not too much. Inflation heading lower. What more do I want?
Max Kettner, bullish, still bullish, the chief multi-asset strategist over at HSBC. Your market, positive, just about by 0.1% on the S&P 500. Yields higher, just about by 3 basis points. Let's call it 360 now on a 10-year. On a 2-year, you can call it almost 420. Yields are higher right now by a couple of basis points on a 2-year, Tom. 4.176%. Let's call it 10 minutes away from the jobless claims number, 13 minutes away.
We'll be watching. I don't know if the Walmart CEO's watching. I love this headline. I have no idea what it means, John. What CEO speak is this? Walmart CEO sees inflection in ROI in coming quarters.
You want me to translate?
Yes, please.
Return on income.
He also says this. Signs of stress on consumers below the surface, and I think that's the more important piece of this right now.
Yes, I think so.
The trade down that we are seeing potentially from elsewhere. The fact that the average transaction at Walmart is up, but more shoppers are coming in as well. And they're coming in from where, Lisa? And that's the trade down story.
Right. Basically, people with higher incomes going to a place with lower prices because they just can't afford what they're being charged at other establishments that we won't name, or maybe we will for the rest of the show.
Red and green on the screen. Futures up 5. I guess that's a good idea. VIX 16.87 gives me no information. Who does give me information is James Bianco, president and founder of Bianco Research, who does a really elegiac effort here on economics and dovetailing it into the state we're in. And then, as John mentioned, there's the debt and the deficit. I read Heilbronner Bernstein years ago, just the Bible on all the sum of our fears here. How afeared are you of the debt debate?
I'm probably more aligned with Wall Street. I mean, there's two types of people when you talk about the debt debate. There's those, to put it in Bloomberg terms, that Anne-Marie Horton would interview that would tell you there's a 40 or 50% chance that we're going to default. And then there's the Wall Street types that'll tell you that there's a 3 or 4% chance that we're going to default. And I'm probably in the 3 or 4% chance that we're actually going to see a default. We're going to see a lot of political theater. And I think what the markets heard from Speaker McCarthy the other day was that the president has appointed somebody to negotiate with him. So that means we're going to get a deal. And I think that a deal is largely expected in the market. And if there was not a deal, that would be the surprise.
So there's a market call to make as well in that. What is your market call around this story?
You mean around the debt ceiling?
Well, if you believe it's not priced, then you also believe you acknowledge to some degree there is some risk here.
There is risk.
Where do you think that risk is?
I think that risk is really in the short-term bill market. And I think that risk is potentially in the banking system. Remember that Treasury bills, Treasury securities are used as reserves. That's a fancy way of saying they're another form of money, is what they are. And if we were to default on those, we would throw the banking system into complete chaos because their reserves that they use would no longer be worth anything, at least for the day or two or three or however long we didn't pay them. That's the risk that you would face if we were to have a default. And there is a risk out there right now that if this negotiation falls apart, I don't think it will, but that is your risk. So you've got to use a fancy word, an asymmetric risk. If there's a deal, there's going to be very little movement in the market. If there isn't a deal, we're going to have to reprice the markets then.
Where there's a problem, the Fed has a solution, typically. Do they have a solution for that?
I don't think they do, nor do I think they should. This is a political issue, is what this is. We elected congressmen and senators to represent us. And if they're in their infinite wisdom decide to represent us by defaulting on its debt, we'll have to figure that out.
To your point, though, if that becomes a market functioning issue, doesn't the Fed have a role to play?
It does to some extent, but you also have to be careful that you're not undoing the will of Congress. Where does one end the other? That's why I think that this will get resolved, because it is all on Congress if this happens, if we have a debt default. It is not on the Fed for mitigating it.
What's the next crisis then? If this gets off the table, then what do people focus on next?
Well, I think we go back to focusing on the banking crisis. And I think we go back to focusing on, go back to the senior loan officer survey. Do we see lending, tighten up and continue to tighten up? And do we see problems then metastasize because lending is going to continue to tighten? And then I think the other one would probably be, if, going with my forecast, do we see a bottom in inflation this summer? And then does the Fed come up short of their target? And does all the talk of cuts in the funds rate by the end of the year kind of go away?
Do you feel like people are exhausted by the pessimism, that they've heard the sky is falling for so long and it hasn't happened, that they're basically tuning it out and basically saying, yeah, you've been wrong, which is basically some of the messaging that I keep hearing. How much is that really kind of prevailing?
Well, I think it's prevailing quite a bit. I mean, it goes all the way back to the pandemic when we had the ultimate pessimism. We were all going to die. That was what we had for the pandemic. And then we all didn't die. And then we've kind of recovered from that. Yeah, I mean, I think there's a lot of frustration. I'll go back to what I said earlier. The markets haven't done anything. So no one is right, no one is wrong. The optimists are still waiting for the breakout, and the pessimists are still waiting for the breakdown. And this just continues, and the frustration continues to build.
If there is no debt ceiling default, right, and we do have that sense by the next Fed meeting, and we don't really have a sense of ongoing stress that's really coming to a head in the banking system, how much of a disruptive force would the Fed be if they actually did hike rates at the June meeting? Oh,
I think they would be a hugely disruptive force if they continued to hike rates. They would exacerbate the bank walk. I mean, this is becoming the national pastime right now. Is pull out your phone and brag about your money market fund. It's no longer about a meme stock anymore. And that would just exacerbate that. And at higher rates will then definitely filter through in the economy. Count me for one that still thinks that rates matter, and that if the Fed wants to raise, I know that's a wild thought, but if the Fed wants to raise rates, it's going to really hurt the economy.
Brett, was everybody modeling a 6% money market fund? I mean, imagine that.
We actually, I think Lindsay Piegza was talking about a 6% Fed funds rate still on the table, even though everyone's taken that off. And then
triple lever cash.
Thank you. It's worked out well. We had a 2.20 payout last year. This year, I don't think we're going to do it. Ralph Ankapour, you're a CMT. You and I adore Ralph Ankapour. I know Ralph. He was on the show, and Ralph said October was the SPX bear market low. We're up 14% SPX off the Ankapour low. That, to me, is stunning. Nobody's talking about this. And a lot of people missed this lift off this low, didn't they?
Yes. So we're 6 months and 14% off the low. But I would also say, if you wanted to back up and look at the January high, we've only retraced half the losses.
Stay with me on my story here. Don't give me this technical analysis stuff. Go with the story.
Yeah, the market has lifted off the low, but what I'm saying is it's still well away from the highs, and it's been meandering sideways. So I see a market without a conclusion right now in terms of the sideways. It's waiting to see what comes next.
Remember the first time you read John Maggie? This is a textbook, John, written in 1940-something. You read Maggie, and it's support and resistance. And the bottom line, John, is you can make up any story you want. So I got a story. I'm coming from the October low, and the smart guy over here is going, no, you got to bring it back further, and it's not that glorious of a story.
Technical analysis of stock trends by John Maggie. So
my favorite story right now, allow me to share it with you. I can get behind this bill in Washington, D.C., the No Pay for Congress During Default or Shutdown Act. Do you like that? Doesn't that sound great? Awesome.
Who's the sponsor?
The sponsor, Representatives Abigail Spanberg, a Democrat, Virginia, Brian Fitzpatrick, Republican, Pennsylvania. Love that. Love that. So this is what NBC is saying. A bipartisan bill set to be unveiled today would block members of Congress from getting paid if the U.S. enters debt default or if the government shuts down. I think we're all on board, which means one thing. If we're all on board, they certainly aren't down in Congress, are they?
Well, this is revenge of the middle. This is revenge of the centrists, right? It's revenge of the guys. What are we doing here? Trying to gain political points and holding the U.S.'s future in hand.
Can you get behind that, Jim?
Oh, of course I can get behind that. I think we should go with when we hit the debt ceiling and retroactively stop paying them since January.
I've said all along, just pay them in T-bills. Just pay them in T-bills.
Pay them in January 1st T-bills and January 8th T-bills.
Who did you want to do that?
I wanted in the Eurozone debt crisis, they should have been paid in BTPs and in Greek debt. Pay the German politicians in Greek debt. That would have got things sorted quickly.
The most important message is Spanberger's ex-CIA, and she won her primary 50 to 48%.
Yep.
She's in the middle.
True.
And that's what the middle of America's thinking.
Hey, Jim, this was great. Love
Thank
it.
you.
Jim Bianco of Bianco Research. Next hour, Caterina Simonetti, Robert Tipp, Jeffrey Sherman of Double Line Capital. Looking forward to that. Jobless claims with Mike McKee up next.
Bloomberg Surveillance, we say good morning to you. Lisa Abramowicz and Tom Keene. John Ferro preparing for another hour to move forward here through the morning. Futures red and green on the screen. Dow a little bit negative. Fractional. It's eased up a little bit. The enthusiasm seen earlier in the morning, and the enthusiasm now goes to the economic data. There is existing home sales at 10 o'clock. But before that, the Philadelphia Fed Business Outlook, top of McKee's list. Forget about it. Claims first.
Well, it would be great if claims would come out. Here we go. 242,000, which is down from the originally reported 264,000. We'll get the revision in just a moment, but definitely going in the opposite direction. Now, remember last week we had a big jump in claims, and then it was reported that a lot of that came from fraud in unemployment insurance filings in Massachusetts. So that may have gone away, and that may have accounted for this big drop during the month. The 4-week moving average, which would still incorporate last week, continuing claims, 1,799,000, but that is down from the prior week as well. So at this point, we are not seeing a real change in jobless claims that would portend something for the overall labor market. Philadelphia Fed is out, as Tom mentioned. It is negative 10.4. Now, that's up from negative 31.3 the month before. Remember, earlier this week, we had Fed, the Empire Index just absolutely collapsed, and people were worried about what that would mean for ISM. But now it looks like the Philadelphia Fed is going in the other direction now. What everybody wants to know is the prices paid index, 10.9 for the Philadelphia Fed. That
Positive
is up.
10?
Positive 10.9. That is up from 8.2. So that's not going in the right direction, which will set us up for our will the Fed, will they not in June debate. Prices received at a -7 versus -3.3. So it looks like people paying for materials and not at this point getting that back. And finally, the employment index, -8.6 versus -0.2. So it looks like the employment situation deteriorated a little bit in the Philadelphia Fed district.
Mike McKee, thanks so much. An eventful week, to say the least. And congratulations on talking to, was it 32 Fed speakers you talked to?
Something like that.
32.
And I was told by...
You're a saint.
I know you've got Ellen coming on. I was told by Seth Carpenter, her co-head of...
Carpenter gets the golf trip.
He said to say hello to her and thank you for the advice about the sunscreen.
Very good. Oh, okay. 4.20. Lisa, we got to look at the yield up 5 basis points, and to go from 386, 387 over the last couple of days up to a much higher 2-year yield speaks volumes.
We were looking for unemployment claims to keep rising. They are going in the opposite direction. Is this enough for the Fed to hike further? And that's what I think the market is playing with. And not only that, but how much does this keep them from cutting rates? And you could see that in the Fed funds futures with now the idea of just sort of creeping higher, the idea that perhaps there's a greater probability that the Fed will remain on hold.
One of the piercing notes of the era has been out of this pandemic where there was a belief in transitory, and one day the chief U.S. economist of Morgan Stanley said, I'm wrong, maybe it's not transitory, it's something new and different. Ellen Zentner joins us now, quarters on from a transitory economics. And Ellen, in your note today, you are framing out a new job economy. We are at a 250,000 run rate on non-farm payrolls, and you have a stunning observation of a path to 40,000 non-farm payrolls. How close are we to that?
Yeah, so I think we can hit that late summer, Tom. And, look, you want to assume that things are linear, which they're never linear. Then if you look at the slowdown that we've had and just project that forward and say, knowing nothing else, let's just assume that continues, you would be down below 100,000 within a couple of prints. So, look, we see a slowing path for job gains here, but we don't see a cliff. And I think that's very important. Claims are still low. Companies are still doing more labor hoarding than they are laying off. We see an employment gap that still needs to get filled. And so I think there's a lot of support here that, let's be realistic. Things are slowing, but this is not a cliff that we're headed toward for job gains. This is, Lisa, to me, the conundrum for you, me, and John into May, into June, into July, is we don't have a clue what is Ellen mentions, the linear flows here on labor. No clue.
Given the fact that it is slow, how does the Fed respond to a slow burn, given the fact that they are continuing to say inflation's our preeminent concern and inflation has been sticky? Ellen, can they afford to not hike rates again if we continue to see just a slow grind lower, but not that quickly, and inflation still higher?
Yeah, so Lisa, I think it's a good question. Inflation is moving in the right direction, but very stubbornly so, and it's not moved down clearly and convincingly as Chair Powell has wanted. But that was not a prerequisite to them stopping hiking, right? That is a prerequisite to when they make adjustments, say normalizing policies. Inflation has come down a lot. So right now we think they're at the point where, yes, it's arguable on the Fed whether they are in restrictive territory. How far are they in restrictive territory? Are they close enough? We think that they're close enough, but the arguments that the points that you make would suggest that you need to keep that peak rate there for quite some time. And I think that's the argument that the Fed will lean on, that as inflation slowly comes down, but they're holding rates high, policy actually maintains its restrictive territory and in fact gets even more restrictive throughout the year. And I think that's what policymakers ultimately will lean on.
Ellen, we were talking about this earlier, and Tom asked the question, do we have a sense of what the new neutral really is? Do we have a sense of what it takes to really take some of the momentum out of an economy that has defied all expectations that were incredibly gloomy heading into the year? What's your view? Do we have a better sense of what that neutral rate is?
So I would say that there's, very cynical of me to say that neutral does not exist. We're never at neutral. We pass it up, and in hindsight, whether you're at neutral, below neutral, above neutral, but we're always reaching for these sort of fictitious metrics or goals. What the Fed does know or can see is that things are slowing. We think they're going to be very slow in the middle 2 quarters of this year. And that's an economy with a backdrop of banking pressures, of volatile financial conditions that you might not want to push it further, but you want to maintain the option to hike again if you need to. And I think that's something that we have to consider. There are two-sided risks after the pause here.
Ellen, I got to rip up the script. You've done it with me before. Don't panic here. And the answer is we're going to talk to Ellen Zentner, foreign exchange strategist. Moments ago, euro dollar, solid 110 forever, just breached through a 108 to a weaker euro, 107.99 right now on euro dollar. To me, the great unspoken, along with your idea of NFP down well under 100,000, is resilient to stronger dollar. Dovetail that into your call. Do we get a resilient dollar again with the certitude out there, the consensus of dollar weakness?
Look, I think that currency movements are very important. And of course, where strategists are, shorter term tactically on the dollar matter a good deal. But I think there's going to be a realization here that the economy is not collapsing. And in fact, a realization that, yes, we think the Fed has paused here, but there are myriad options for policy after that, right? It's very easy to get inflation down from 7% to 4%. It's very difficult to get inflation down from 4% to 2%. And that might take more work from the Fed after they pause. So I think it's more of that realization creeping in that 5.1% is the peak now, but they may have to move higher at some point.
At least to me, this is so important, dovetailing in what Ian Lingen said with what Ellen Zentner said, and the idea of the asymmetric call, and this is frankly Hollenhorst as well. Do you get a symmetric call where you get rates up or the Zentner pause, and we don't understand the duration of that pause? And that's where you get the dollar dynamic to come in.
Well, and we also have the sense that Europe perhaps has seen the bulk of the gains, and perhaps there are signs that the other side of the trade isn't doing as well as the resilience of the U.S. economy. Ellen, to that point, we were talking with Jim Bianco of Bianco Research earlier, and one of the big fears about the U.S. was the banking crisis that wasn't, or the banking crisis that hasn't yet materialized. And he said it's too soon to say all clear, which a lot of people have been saying. Do you agree with this idea of a bank walk, of sort of assets just kind of tiptoeing out the door over a longer period of time, more akin to the 1980s S&L crisis, that still hasn't fully transpired?
Yeah, so I think, look, we've had a shock to the system. That takes time to flow through. I don't believe this is a credit crunch where we've just choked off the flow of credit to the economy, but it's clearly a credit cycle. And it's coming also from a drop in loan demand. So I agree. We can't assume that we're past sort of these evils lurking around the corner. But I think one of the difficult things here, which is very different from the 80s, is that banks are now having to contend with sentiment. So think of a bank that's had an equity event, right? An equity investor does not want to own that stock. So the stock goes down, and then like clockwork, within days, outflows of deposits because you're suspicious of, is that bank where I'm holding my money safe? So it's a sentiment. And then you've got bank runs that move at the speed of light that are electronic now. And so this is all something that the banking system has to contend with. And I think will continue to weigh on credit availability and lending for some time.
Ellen, when you talk about the bank walk and later this year, does it become that much more sort of pronounced as a result of the Fed remaining on hold if the economy is also slowing at a commensurate level? So basically, the relative yield that you're getting on those T-bills is that much better.
Yeah, so look, I think for banks, it comes down to liquidity. And you can look at it one way and say, well, banks are accessing the facility that the Fed has put in place, or they might be accessing the discount window. But ultimately, the other side is the way I would look at it, is that's a good thing. Banks need liquidity, and they're accessing it. And so that alone will help banks work through this.
Ellen, I want one final question. There's a guy named Gorman. I think his first name's James Gorman, and he said a number of months ago something like, and he said it with that accent he's got, that, you know, that Australian thing going. He said with some fury, if they can eat in a restaurant in Soho, they can come to work. I'm fascinated what you see nationwide on back to work. It's a big debate in Manhattan, but are we going to go back to work in America?
So we are going back to work. I think when I've traveled around the country, I find a good deal of regional differences in terms of people that are back to work full-time, almost full-time. Look, why does this need to be a worry? I mean, yes, office space for commercial real estate is working through problems, resizing. It's more of a tier B and tier C market than a tier A problem. But still, we don't have to be in 5 days a week. That's not what new work arrangements need to look like. But we do need to connect.
See you in a restaurant in Soho. We'll try to ignore Mr. Gorman if we can. Ellen Zentner with Morgan Stanley, working for the James Gorman. Coming up, lean forward on the media, on the changes in Hollywood. Jessica Reif Ehrlich will join us with Bank of America. She is definitive on Hollywood. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and other group of 7 leaders have begun arriving in Japan for their summit. China and Russia will be the problems at the top of their agenda starting Friday. Russian President Vladimir Putin continues his war in Ukraine, and a post-pandemic China is busily expanding its economic and strategic clout. Meanwhile, China has kicked off a European tour aimed at brokering peace in the war between Russia and Ukraine. A top Chinese diplomat met with Ukraine's President Volodymyr Zelensky this week. Li Hui told Zelensky that ending the war would require all parties to build up trust. Ukraine has said it won't accept proposals that include the loss of territory. President Biden hopes to be reelected next year by defending his victories in 2020 battleground states. But he also wants to expand the map into states like North Carolina and Florida. In a memo obtained by Bloomberg News, campaign manager Julie Chavez Rodriguez argued that Democrats strengthened their hand with their performance in midterm races and in this year's special elections. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've got a lot of work to do to continue to develop features that support advertisers. We're rolling out things like measurement and verification, but we've got, a bigger, longer roadmap that we have to go do there. We'll be working with advertisers and members to try things and then let them tell us what's working and what's not. Scale is relevant in the business, so we have, we're getting to a certain size of scale that shifts how advertisers think about us.
Greg Peters with Netflix, their co-CEO. All I know is scientific research, Lisa. Netflix is on at the Keene household. There's like 14 streamers, and that's the one that gets the most FaceTime.
What's the show?
Oh, it varies. There's like Addams Family Redux or whatever. It's been successful. They've been on a roll on a creative basis, to say the least. For Global Wall Street, and particularly for those focusing on what we consume at home, she is definitive. Jessica Reif Ehrlich joins us now, senior media entertainment analyst at Bank of America. Forget about all the titling. Here's the bottom line, folks. She had to get a restructure done on the living room mantle because 14 times she's taken home the trophy of institutional investor. All you need to focus on, folks, I don't know anybody that's ever done that. Jessica, honored to have you with us. In the old days, you'd wander out to Capital Guardian Trust. You'd talk to Gordon. You'd think about, Comcast. What are they going to do with free cash flow? It's all been blown up. Hollywood's a train wreck. Where's the opportunity?
Well, I think you guys just hit the nail on the head with that Netflix clip. They are clearly going to take share. There's just not even a question. Look at the engagement on their platform. They're just beginning to roll out advertising. It will be uncluttered, so 4 to 5 minutes an hour, with a highly engaged audience, relatively young, addressable, targeted. So there's a very, very long runway here. But I would say if you step back, AVOD, or advertising video on demand in general, is where the share gains will be. So Netflix is going to be a winner over the next 3 to 5 years. But so will some other companies. Warner Brothers Discovery seems to be very well positioned. They're rolling out Max next week, May 23rd. Disney's platform will get bigger when they roll in Hulu. So there are some major players in this area.
To go to the current chit chat, Jessica, the upfronts just happened. This is where everybody rolls out stars and smiles. You've seen so many of them. It's like, yeah, okay, no big deal. How did Warner Brothers Discovery do in an upfront FaceTime of the mating of those two dinosaurs? How did Mr. Zavlev do in identifying a new WBD?
I thought they did a great job. It was their second year, their second upfront as a combined company. They had all of their management team. Of course, nobody had talent this year because of the WGA strike. But they did a great job. They did a great selling pitch, why advertisers should come to them. Their product is really broad and really deep. They have the best library. It's a big library, but it's the best library. And they have a lot of originals that people look forward to.
Will we see a mating of streamers? I mean, I looked at I think it was in Variety, I looked at a percentage of people getting eyeball time with Lisa's kids, and there's like Netflix and that, and all the others are really behind. Do they have to merge to survive?
Yeah, I mean, Netflix is so far ahead of everybody else. There's no competition and no comparison. I mean, their engagement is humongous. The scaled players are Warner Brothers Discovery, Disney. Not to say that Warner Brothers Discovery can't get bigger, they can. And the other players, our view is there will be consolidation.
Going forward, there's a real view on the consumer as well. We've been talking about that a lot this morning, about the state of the U.S. consumer. How much pushback is there on cracking down on password sharing and this concept of people continually willing to pay more for some of these services, even at a time of potentially constrained income?
Well, what's interesting here is that Netflix is not raising prices this year. Their price increase or their revenue driver will be the crackdown on password sharing. And they have a relatively low-cost offer. For $6.99, you can take Netflix and get two streams. You can download high quality. So they've improved the product that they're offering as long as you take ads. If you don't want to pay, it's $9.99 for the lowest price. But $6.99 for all of that content is fairly compelling. And the crackdown, basically when they crack down in the U.S., which will be this quarter, if you're a password borrower, as they call them, if you're not paying for your own account, you will be cut off. So there's a choice to be made. Do you want to pay $7 a month and get all that content, or go somewhere else, which is more expensive?
Tom, this sounds like one of those ads. It's only $6.99, but wait, you get some advertisements. And Jessica, I do wonder if that's really where this is going, that basically the marginal income will continue to come from advertising, that advertisers will flock to these platforms, and that consumers, as they bump up against those price pressures and password sharing crackdowns, will be willing to accept advertising that initially they weren't.
Well, while there's resistance to advertising, thanks to Netflix, the reality is that it does pay for a lot. And these are highly engaged consumers, and so as consumers move from linear to streaming or to digital, the advertisers have to follow. And for consumers, it's it's uncluttered. On linear TV, we're getting 15 plus minutes an hour. On streaming, it's basically 4 to 5 minutes, depending on the streamer. But with Netflix, Warner Brothers Discovery, and Disney, it will be in that zone.
Right.
And so for 5 minutes targeted advertising, I think consumers will.
Jessica, I just did a 25-year survey. This is the first time Jessica Reeve Cohen won the Institutional Investors Award, and I just did a regression in Netflix, and they're down almost 2 standard deviations from the glory days. To get to the center tendency, Lisa, Netflix goes up 145%. Jessica Reeve Cohen, is that the vision you have of Netflix, literally having a double capability?
I mean, it depends on the time frame, but yes, if you have a multi-year time frame, this is the stock to own. I mean, even in the near term, we love it, but yes, I mean, this is a stock that can. Well, I mean, look, there's 2 major obvious drivers, which are password sharing crackdown, which will be a huge driver here next, and then advertising, which will be a 3 to 5 year driver. Not to mention their content has just been off the charts. Literally, they dominate.
Jessica, thank you so much. Honored to have you with us. Jessica Refairlick, one of my heroes with the Bank of America Securities today. Lisa, that's a scope and scale. And the adults in sell side, like Ben Laidler at HSBC, and now with eToro or Jessica Reed Cohen, they're iconic, absolutely iconic. Their scale is they're not looking 6 months out. She's looking at Netflix as an extrapolation out 12 months, 3 years, 5 years. And like Michael Nathanson say at MoffettNathanson, all of a sudden these ginormous stocks are like a double if you believe in the story. I'm not advocating that, but that's the scope and scale.
There's been a massive transformation, no doubt, in terms of cord cutting and just the way that people consume media. It was expedited during the pandemic, but as we settle out, it's clear that there are some structural shifts, and who's the winner and who's the loser is going to become apparent as we move forward.
Don't you just look at what's going on at your house? That's what I do. I mean, they're watching.
I try
Netflix.
Not to.
Yeah, really.
I try not to know.
No, that's true.
Especially as they continue with their screens.
I get the Disney Plus, the young kids and all that, and we don't have the like pineapples watching Disney Plus 24/7. One of our staff's friends, daughters rather, but they're watching Netflix. That's all I see. When I walk by, it's Netflix.
Can I just bring you this? Lori Logan was speaking of the Dallas Federal Reserve, and she said the current data does not justify a pause. This seems to be a growing feeling among a certain cohort on the Federal Reserve. Perhaps this is just talk to push back against some of the rate cuts priced into the market. But you are seeing that grind higher in the 2-year yield, now 4.23%. But how much they're just seeing the mess. And this sense that, the economy isn't doing so badly. Retailers are doing just fine. And there's a story here that they can't really lean against by just saying, but wait, what about the banks?
Yeah, and you see that with this is critical, the vanilla spread. We've talked about a lot of different comparison of yields today in the 2s, 10s, the difference between the 2-year that Lisa was just mentioning and the benchmark 10-year note critically goes through 60 basis points of inversion, now negative 61. I haven't done the technical work, but I defer to Priya Misra on that, among others. But the answer is, you go through 60 basis points, that's a benchmark. The real yield up 4 basis points, 1.38%. Maybe not a breakout, but nevertheless, this is percolating. And I'd also mention, away from the China gloom and that, we were waxing philosophical about $69 West Texas Intermediate, 72.38, a nice little lift in oil as well.
Yeah, just jobless claims aren't ticking up. I mean, they went down from 264,000 from the prior week to 242,000. A downside surprise amid a market that's supposedly, a labor market that's supposedly loosening.
The debt ceiling, it's part of the topic at Hiroshima, Japan. Anne-Marie Horton is with the president in Japan for the G7 meetings. That debate continues. The senator from Arizona will do that in the 2:30 hour. This is Bloomberg.